The Fed has given very strong guidance about what they're going to do, but they've probably reached a maximum level of rhetorical hawkishness.
In the end, with inflation this high, it's very difficult for the Fed to change its reaction function.
I'm afraid the Fed's going to have to do more, and I think 50 basis points July and June.
The Fed is tolerant of inflation above 2%, so this is going to take time before we get to the point where the Fed really has to hurt us.
We're taking the optimistic case here that the Fed will be able to pull this off.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures down 0.5% on the S&P. TK, Jeff Curry and the team over at Goldman. Get your attention, get mine, get Lisa's too. 140 on Brent, their new price target for 3Q.
And John, a chart you put on Twitter says it all. This is not about a spot estimate. This is about a sustained set of quarters, even years of higher oil prices we're not yet ready for.
Triple-digit crude, Tom, through the whole of 2022 and 2023 as well. And that's what's needed to rebalance this oil market, Tom, in the minds of Jeff Curry and his team.
Well, that's the oil story, but I'm seeing it as well. John, as you and I talked about yesterday, I think Lisa chimed in on this as well when she wasn't looking at the auction calendar. I got a 3.02% on the 10-year yield. I've got a yen out 131, 132. Our first guest is going to talk about that. These are tea leaves of a shift of what Bullard would call a new regime.
Yields up in the last 24 hours. The conclusion, central banks have more work to do. And Bramo, the RBA front and center overnight.
Surprising with a 0.5% percentage point move, highlighting how a lot of these central banks are trying to get ahead of the inflation that they're seeing that continues to have some legs. And this is really the dilemma that I see. There was a story out on the Bloomberg this morning about how supply chain disruptions are starting to ease a little bit. You see this with the chips and the auto manufacturers. But is it enough to bring inflation low enough to create some sort of easy balance at a time where we're seeing, on an adjusted basis, inflation very reminiscent of the 1980s?
Is that RBA move an appetizer for the ECB?
Yeah.
Later this week.
Okay, there's a 0.5 percentage point move actually baked into market expectations at some meeting by the year end by the ECB. I mean, we're talking about how outrageous it was to even be talking about that after the negative yielding environment. But here we are as a base case heading into the year end.
Question, John, can we do a dumb question at 6:02?
There are no dumb questions at 6:02, TK.
They're
far
all
away.
raising their
Hold that
rates.
thought.
How does Japan get away with not raising rates? I don't get it.
The inflation backdrop's very different for a start, Tom.
Or so they say.
That's in their favor. What they can't do, though, I think, is ignore what's happening with the bond market. That's where things are going to get tremendously difficult.
Yeah.
For a long time, the centre of gravity, I think, for the global bond market has been JGBs and bund yields, Lisa, just a wait on 10-year treasuries. That's going to change now with an ECB starting to tighten, think about doing so, and some double tightening from the Federal Reserve. Can the JGB market just sit there and do nothing with the Bank of Japan trying to sit on top of it?
Put another way, the Bank of Japan has had the rest of the world moving with it for the past decade. Now they're going to see the rest of the world move away from it in a dramatic way. And can it sustain its normal at a time when everybody else is facing a very different reality?
Will they get dragged with them,
Right.
kicking and screaming? Futures this morning on the S&P, just a little bit more negative, softer, lower, down by 0.5% on the S&P 500, down 0.6% on the Nasdaq. Yields come in a couple of basis points on a 10-year to 3.0178%. But that's not the story this morning. The story was yesterday. Yields higher, Lisa. What on? Not much.
Maybe not much. And yet there does seem to be a feeling that people perhaps got ahead of themselves with this expectation that we were seeing some sort of rollover and that central banks might pause. Remember the pause, the Raphael Bostic pause that quickly got thrown out as people started to look at the data. As far as the data goes for today, this is for you, Tom. 8:30 a.m. we get the U.S. trade balance for April. I have another one for you, too, coming up. But this one is interesting because we've seen a record deficit in terms of trade with the U.S., and this has come on the heels of a dollar that has strengthened. The U.S. can export and import things much more cheaply on a relative basis because of the dollar. They can import more goods, and that has come on the strength of the dollar. How much, though, does this remove from GDP? Because basically people expect that if this trend continues, that we could see 1.5 percentage points taken off GDP this year just simply because of the trade deficit that we see in the United States. At 10 a.m., Treasury Secretary Janet Yellen is testifying to the Senate Finance Committee. The goal is to analyze analyze President Biden's 2023 budget. The reality is this will be a discussion about her view on inflation and what she wrote, or possibly what she indicated off the record in that biography in terms of not wanting the stimulus in 2021 to be as big as it was. This comes ahead of that CPI report later this week that is expected to come in still hot, perhaps a little bit decelerating, but still, how quickly do we have to see that inflation decelerate in order for people to feel more comfortable? At 1 p.m., this is the big one, the U.S. Treasury Department is selling $44 billion of three-year notes.
Yes.
This is particularly interesting. No, this really is. It's because it is the first auction affected by the quantitative tightening, by the lack of reinvestment of the Treasury Department back into the market. I don't know that this is going to roil everything, but it's a really important watershed moment, John. The beginning of quantitative tightening at a time when people have a very unclear view of how that will affect the market.
I can't decide whether you're trying to wind up Tom or not. Are you serious? It's important.
I always find them important.
Okay, just to clear that up. Because I know part of this is just to wind TK up because Tom hates this stuff.
Hold on a second, John. Did that clear it up?
Not really, but okay, thank you.
We can discuss it later.
We can do that a little bit later
German
this morning.
judge gives it a 7.
And Tony joins us now. Tony Crescenzi, portfolio manager at Market Strategist over at PIMCO. Tony, we won't talk about supply and auctions just yet. Let's focus on this soft, hard landing debate. Where are you and the team on that? And how would a $140 crude price influence your thinking?
Well, it does seem like the odds of a soft landing are reasonably good, but it's tough to manage. What the Federal Reserve wants, of course, is to avoid an outright recession. Recession defined as a decrease in employment and output. What it wants is a growth recession, which is that soft spot, the soft landing between 0% growth and 1.8, which is the growth potential. Navigating it into that narrow runway is challenging. The price of oil rising, of course, will reduce aggregate demand, perhaps, and that will likely help bring it into that zone. But lots of other things have to happen. Lots of things can be broken along the way. For example, we see the Federal Reserve affecting the housing market through higher interest rates, et cetera, very difficult to manage. But the final word I would say is it does look like the chances of a soft landing are pretty good. The chances of a deep recession are pretty low.
Anthony, I want to talk of all your expertise across the globe on short-term paper. The anomaly is Japan. Can they ignore the Fed, the ECB, the Bank of England, and everybody else, including RBA, as John mentioned earlier? I mean, it's out there that Japan wants to play by a different playbook. Can they get away with that?
The real challenge is when the Governor Kuroda, who leads the Bank of Japan, leaves next April. There will be a communications challenge, and communications are awfully important to central banks these days, sometimes more important than the actions they take. And they'll have to navigate that period, which could be tumultuous. And so it's possible that Japan will have difficulties in the same way that some nations have difficulties defending the currency pegs. So if interest rates are high globally, it might get challenging. What will help Japan, of course, is the very challenging demographics, with the population continuing to shrink at 125 million today, looking like it's going to go to under 100 million by the year 2050. So that's a force that will keep wage pressures down, it's expected. And the cohesiveness of the society enables it to achieve certain goals. But again, the communications challenge surrounding the passing of the baton to the next governor is going to be pretty high.
Tony, when we talk about a softer hard landing in the United States, we're also talking about the measurement of inflation, as Larry Summers pointed out, former Treasury Secretary, in a study that came out yesterday, saying that basically on an adjusted basis, inflation right now is highly comparable to the peak that we saw in 1980. Do you think that that creates a real problem, given what the Fed has to do in order to bring inflation back down to their target, or do you just reject it?
Well, the Federal Reserve is succeeding in many ways in keeping inflation expectations from moving upward, and it appears as if it's helping inflation expectations to move downward. We can see this in the Federal Reserve's favorite gauge of inflation expectations, the so-called five-year. The five-year is a way of leaping past the noise from the rise in the price of oil, rise in food prices, the rise in lots of things that are occurring in the short run, partly because of cyclical reasons, partly because of the pandemic, and also the war in Ukraine. It's a way of looking at where inflation expectations looking 5 years out will be 5 years forward from that, which is a 10-year horizon. And that figure's come down from a 250 to about a 220. And finally, Lisa, looking at the term premium, the amount of yield that an investor gets for moving out along the yield curve, it's still negative. And historically, it's been positive. In other words, you could simply glance at the yield curve if you don't want to gauge this mathematically, and see you're not getting much to move out on the yield curve. And that means there's not much term premium. There would be a larger term premium if inflation were a bigger worry. So this is a long way of saying market participants still view the Federal Reserve as credible and will succeed ultimately in achieving its inflation goal of 2.6% for the end of, not a goal, but its expectation, 2.6% for the end of 2023. The question is how it gets there. Does it require a lot of tightening, or do we get the elusive soft landing?
Hey, Tony, thank you. Tony Crescenzi there of PIMCO. Bramo, for all the doom and gloom we talk about day after day, do you sense that is the consensus view? Because I'm not sure it is. When you look at the South side, particularly on equities, the consensus view seems to be still pretty constructive, with this idea that inflation does start to decelerate pretty quickly through the summer and the Fed ultimately backs away at some point this year.
The number of notes that I've been watching and reading that have come out in the past week pushing against the gloom, saying, guys, what are you doing? I mean, yes, we talked about Lloyd Blankfein's tweet over the weekend, basically saying, okay, everybody has to basically gird for the worst case scenario, but come on, things aren't that bad. That has been the consensus, is people pushing back.
And Marko Kolanovic and the team over at JP Morgan agrees. They see opportunities. This is what they say. In innovation, China ADRs, small caps, energy, biotech, etc. Go on, Lisa. You're itching to say it.
Okay, come on. It's Marko Kolanovic. Has he ever been bearish?
I'm just saying.
I know, but it's just,
people are waiting for that moment that maybe
sure.
He's no longer bullish, but he still is. Futures down 0.5% from a beautiful New York City, a quiet summer morning so far. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Boris Johnson has managed to cling to power. The question now is for how long. The British Prime Minister survived a confidence vote by lawmakers of his Conservative Party. 148 Tory MPs voted against Johnson. That rebellion was bigger than the one suffered by his predecessor, Theresa May, who was ousted as Prime Minister 6 months later. The US has warned Kim Jong-un there will be a strong punishment if North Korea conducts a nuclear test. Both Washington and a United Nations watchdog agency say there are signs that North Korea could soon set off its first atomic device since 2017. Kim's regime has been test-firing missiles at a record pace this year. And Russia has come out with its own sanctions. It has indefinitely banned 61 U.S. officials and executives from entering the country, amongst them Treasury Secretary Janet Yellen and BlackRock CEO Larry Fink. Moscow says it's retaliating for what it calls constantly expanding sanctions against its citizens. And Elon Musk is threatening to walk away from his deal to buy Twitter if the company doesn't do more to prove its users are real people. But Bloomberg has learned that at the same time, both sides have been meeting and the deal is proceeding. Twitter reiterated it will hold Musk accountable to the terms of his $44 billion proposal. And Kohl's is in exclusive talks with Franchise Group for a deal that would value the retail chain at about $8 billion. Franchise Group's offer is for $60 a share. That has Kohl's surging in the pre-market trade. In February, Kohl's said it had rejected takeover offers because they undervalued the company. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Russia is solely responsible for this food crisis, Russia alone, despite the Kremlin's campaign of lies and disinformation. Global food security is a top priority for the EU, and we will do everything we can to help solve this challenge.
That's the view from Charles Michel, the president of the European Council from New York City this morning. Good morning. We'll be catching up with the World Bank president, David Malpass, a little bit later this morning. This is going to be a key part of that conversation. Equity futures negative 0.6% on the S&P 500. On the Nasdaq 100 down 0.75%. Look out 140 on crude. That's the view from Goldman. Right now 118.25. Just a little bit lighter, lower negative here, Tom. Softer by about 0.2% on the session.
Yeah, Brent comes back 120 down to 119, but again, I'm looking at week yen. 132.67 is extraordinary on Japanese yen. With extraordinary reporting out of 10 Downing Street, Lizzie Burden joins us right now for a quick view here of the future for the Prime Minister of the United Kingdom, Jack Fitzpatrick in Washington as well. Lizzie, I want to cut to the chase, which is the former leader of the Conservative Party, hugely respected, William Hague, writing in the Times of London, this is an honorable thing to do, leave. When does Boris Johnson exit?
Yeah, and another major point that William Hague made in that piece was how the biggest worrying factor for Boris Johnson is how disparate the rebellion was last night. You had young, old, north, south, Brexiters, Remainers. It's not just one rebel faction to tame. And so Boris Johnson has just had a cabinet meeting with his ministers, and he'll have been trying to hold them all together. But it's not just them; it's the party at large.
Yeah, Lizzie, you nail it. And to me, and I mean, I'm sorry, John Farrell's the expert on this. I take him out for a beverage of his choice, and he informs me on the crazy British government. What do the people do in that room with the Prime Minister if they were with the little wooden box and the piece of paper and they said leave? How does that room dynamics happen over the next 72 hours?
Well, don't forget that there are people in that room who are vying for his job. One of the runners and riders, though she's not put her hat in the ring, is the Foreign Secretary Liz Truss. It used to be the Chancellor Rishi Sunak. He was the golden boy until his handling of the cost of living crisis and his wife's tax affairs. But they'll all be jostling for bits for their departments. You know, you've got MPs from the north who'll want more spending there. Rishi Sunak, the Chancellor, of course, doesn't want to be doing more and more and more spending because he warned yesterday about the inflationary impact.
How do they do law? I mean, is it like a lame duck prime minister? That's what we would call it in America. Is this a lame duck? What do you call it, John? A government? Is this a lame duck government?
Well, likely so, because if you just look at the history books, his predecessors, Theresa May and Margaret Thatcher, Theresa May lasted just 6 months after she won a vote of no confidence, Margaret Thatcher a day. So the question is, how long can he last? And that's what all of them will be asking. That's why you've got the runners and riders list circulating.
Lizzie Burden, thank you so much for all of your reporting from Downing Street and beyond. Jack, I want to turn to you in Washington, D.C. There have been a number of reports as we talk about some of the supply chain disruptions about a top economist in China recommending that if there is some sort of disagreement over Taiwan, that China should take over the Taiwan semiconductor company that supplies the vast majority of chips. How is this administration trying to get ahead of some of the disruptions that could get caused in that type of situation?
They may struggle to get ahead of that issue. I mean, on one hand, you have Congress working on their CHIPS bill, semiconductor production and competitiveness bill. That's a much longer term issue. In the shorter term, what the administration does with its rhetoric regarding Taiwan may be either more effective or ineffective, but it's a little bit more immediate. Obviously, you heard, I don't know if it was fully a gaffe, but it was something that the president had to walk back when he raised the possibility of military involvement over Taiwan. The administration can try to handle the day-to-day tension over Taiwan, but the broader supply chain issue regarding availability of semiconductors is something where their options are limited. There's work on a bill that's going quite slowly, and it's a longer-term issue.
Jack, I love the shades of a gaffe that this has become a sort of nuanced aspect. There's sort of a rating of what counts for a gaffe. Going forward, how likely is it that this administration can spend more, even on building up things like supply chains, based on some of the, and frankly, increasing criticism on the stimulus back in 2021 and how it contributed to inflation?
One that weighs on the administration. I think you'll hear a lot of debate focused not even on forward-looking issues regarding inflation, but on the role of the March 2021 stimulus in the hearings that Secretary Yellen is participating in this week. But it doesn't necessarily preclude action on something a little more bipartisan. That bill on semiconductors, the work is still happening. It's a difficult one to move forward, but it's still going. There is a possibility of something deficit reducing through, they're not calling it Build Back Better, but something that could get into some of those issues. The legislative outlook is not totally destroyed because of the role of the March 2021 stimulus, but it is kind of dominating a lot of the politicized conversation as we move to the midterms.
Jack, awesome to catch up. Jack Fitzpatrick there down in D.C. Bramo, did you see the latest move from Russia, that they have indefinitely banned 61 US officials and executives, including Secretary Yellen and BlackRock's Larry Fink?
Yes, I did see that.
From entering the country to retaliate for what it called constantly expanding sanctions against its citizens.
Boom. Wow, that
Larry
really dropped.
Fink in a mix too. Were you surprised by that? Kind of strange.
No, I'm not that surprised by it because he's a huge investor, right? And he actually does wield some control over who gets invested in and who doesn't. And this comes at a time when Russia is preparing to contest the default that they're imminently about to be declared in by saying, look, we can pay, we want to pay, we're being prohibited in paying. And frankly, the creditors in the United States are going to be on the wrong side of this, right? They're going to want them to be in default, and they're going to be pushing them on that front. So it's not that surprising, but it also is sort of inconsequential to me and shows just how little power Vladimir Putin has, that this is the kind of axe that he's wielding at this point in this conflict.
Tom, we'll hear from Secretary Yellen a little bit later today.
We will. It's going to be an important comment. She's got to readjust to the uproar last week, but really what she needs to do, John, is get out front and support her president. And she can do that. I mean, I think you're going to see a lot of different major administration people try to hone in and manage the president's message forward because he's struggled to do that himself.
A chaotic few days for the Treasury Secretary.
Yeah, for everyone.
Janet Yellen.
Yeah,
in fact, I'd say a chaotic week after stepping up and acknowledging she got inflation wrong, then that story over the weekend, the backtracking, now a hearing that we can pay close attention to later. Futures down 0.6%, heard on radio, seen on TV. This is Bloomberg Surveillance. Live from New York City this morning. Good morning on TV and radio. Here is your morning price action. Equity futures lower by 0.6% on the S&P. On the Nasdaq, lower by 8 or 0.9%. Fading into the close yesterday as well as yields started to kick higher. Can you call a low on this, the equity market, without calling a high on this? Bond yields, take a look, 2s, 10s and 30s. Last week up 20 basis points. Yesterday in one session alone without much of a catalyst, up about 11 basis points, back through 3%. A little bit lower on the session, but think about the highs, 320 in early May. All of a sudden we start to think about them a little bit more. Your 10-year, 3.0159%. So can you call a low in equities without calling a top in bond yields? And can you call a top in bond yields without calling a high in the commodity market? Let's talk about this. Crude, WTI, Brent, Goldman, front and center. They think we need some demand destruction. Jeff Curry's been talking about it for a while. Brent crude right now, 119. Jeff Curry thinks that we can strike 140 in the third quarter. And Tom, what's amazing about this, and you noticed it too, is even 12 months out, they're still at 130. They're still at 130 12 months out.
It's my big theme, John. We're on the x-axis, and John, you have to tell me where the x-axis is for Christine Lagarde on the German 10-year yield. I can't run it log because I'm coming from a negative yield, but it is a moonshot off late December, and it legs up to a new higher yield now. It's very different than the U.S. 10-year.
Tom, we have gone from negative about 20 basis points to start this year, all the way up to 130 on a German 10-year. And the calls, Lisa mentioned them, some of the calls from some of these banks for ECB action of 50 basis points. Tom, that's so foreign to anyone who's been following the ECB for the last decade.
Yeah, let's do this now. With futures negative 21, the VIX 25.63. Let's swing over to the equity market. Liz Ann Saunders joins us now, Chief Investment Strategist at Charles Schwab. Liz Ann, let's get out front. Surveillance needs to know your mid-year update. What is it?
not quite as gloomy as what the year ahead outlook for 2022 was in December, but that's in large part given that we're pretty well into a bear market here, certainly for NASDAQ and Russell 2000 and pretty close for the S&P, a lot of churn under the surface. So some of what I think the market is facing has been priced into stocks, maybe not yet the extreme. I think phase one and phase two were about tighter financial conditions, tighter liquidity environment, inflation rates. Phase two was reflecting the weakness in the economy, which of course was witnessed in the first quarter. Now I think we may be in a phase that the market needs to price in a change in the profits outlook. Nothing dire, but I think this may be the first quarter that we start to see a noticeable hit to profit margins.
And what's important here is a separation of profit-making enterprises from those that are not. What happens in a bear market to non-profit making enterprises that have a story? You know, you and I used to call them story stocks. Mm-hmm. What happens to story stocks given the lovely mood we're in?
Well, maybe the question, Tom, is what has happened? If you look at non-profitable tech, which has been a really popular area of the market, Goldman Sachs has an index, you can find it on Bloomberg, that had at its worst a 72% drawdown. So I would argue that that's not really a prospective thing. We've been living in massive drawdowns across the spectrum of these narrative-driven groups of story stocks that really represent the ultimate in a long duration pick because they have no profits right now. So you're investing in them based on the hopes for profits. And at a 40-year high in inflation with the Fed as aggressive as it is, I think there's been a shortening of duration on the equity side as well. And I don't think, other than maybe some trading lifts in call it these lower quality segments of the market, I don't think that's the bet investors should be making at this point in the cycle.
So what should the bet be that investors are making right now?
Quality. I think sort of a quality wrapper. I think the factors that have had consistency in leadership, and I think at least near term will continue to have consistency in leadership, would be things like strong free cash flow yield, strong balance sheet, cash-rich balance sheet, low debt. In this more constrained earnings revisions environment, positive earnings revisions. So all of those have that quality wrapper around them. And I think that's still the approach that investors want to take, even if there are those trading maybe opportunities in the very short term down the quality spectrum.
There's a fight right now in markets and among strategists around whether people are being too bearish or not bearish enough with respect to the economic outlook, whether the idea of recession is a likelihood or an outlier event that could come down the pike. Where do you stand in terms of how investors should think about this, how much potential alpha they should give up hanging out in safety and hedging against some sort of recessionary circumstance?
Well, my answer, Lisa, to that question, if we were at all-time highs, recession versus soft landing would probably be different, because I think at that point it would make a big difference. Given the pain we've already experienced in the market, especially under the surface, even in the case of the S&P, at the recent lows, the average drawdown across the 500 members was 30%. So I think the question of recession, no recession, maybe matters a little bit less right now in terms of ultimately what the downside for the market is. Yes, you can look at history, bear markets with recessions down in the low 30s on average, bear markets without, mid 20s, but there's a wide range around both of those. I don't think that, assuming we're going to get a recession, that's always the better bet if you use history as a guide in tightening cycles. I don't think it suggests an 07 to 09 kind of recession. There aren't so many massive imbalances. Even if housing continues to falter, it doesn't take the entire financial system down with it. This would be the more typical end to a cycle. But again, the fact that the market has suffered a lot already, I'm not sure it makes such a huge difference in terms of where we go from here.
Lizanne, talk about use of cash and talk about profit-making companies that have announced share buybacks. Do they speed them up given the drawdown that we've seen across NASDAQ, SPX, and Dow? Do they complete their buybacks quicker to announce more?
Well, you have seen a pickup this year. And what's interesting is it's not just among the S&P companies, but you're seeing a recent pickup in buybacks down the cap spectrum into the Russell 2000 sphere. And Tom, as you know, when you look at insider buying or selling, insider selling is less valuable an indicator because they can sell for lots of reasons. It's the buying. So you've got insider buying and now buybacks as an attempt to help boost the profits picture. And, you know, in net, that's a positive for the market. And could it accelerate? Sure.
So, Liz Ann, people used to say that companies would borrow to buy back their shares. That's kind of out the window right now, given where the rates are, to borrow money, at least for the vast majority of companies. But when do they actually have trouble raising cash on another level? Deutsche Bank came out with a note this morning talking about an increase in defaults and a return to a higher default cycle. Do you see that as a likelihood?
I think we're going to start to see more trouble. When people talk about spreads in the credit market, they often think of it in level terms, but I think it's direction. So maybe at 7% or so, that's not egregious. But when it's up from 4% and you were maybe on the marginal end of the spectrum having trouble financing foreign change, it becomes much more difficult, even with another couple percent. So I think that's also has the potential to be more of a story in the second half of the year.
One final question, Liz Ann. What's the sweat factor among retail right now? What does Charles Schwab see in terms of flows in and out of equity?
We've seen pretty steady flows into ETFs, the passive side. More of the outflows have been on the mutual fund side. What's interesting about that is we actually have equal weight doing better than cap weighted right now, but not a lot of panic. We saw sort of capitulation on the attitudinal side of sentiment, a lot of fear, a lot of angst and concern, but it really wasn't matched on the behavioral side. And as is almost always the case with our investors, if they have what we call an advised approach, if they're disciplined, they have strategic asset allocation, they're disciplined around that using methodology like diversification and rebalancing, they tend to ride through tough environments more so than the, call it the wing it traders.
The wing it traders, we like that. Liz Ann, thank you. Liz Ann Saunders there of Charles Schwab. TK, do you like that, the wing it traders?
Well, I think Gary Gensler likes it. I mean, we're looking for that,
do you think Gary likes
Wednesday today. And, you know, this is sort of like, it's way too early to do this. 6:39 a.m. We're not talking execution rules and all that. But everybody's been waiting for SEC Let's Go. And today may be the day where they let's go. We'll have to see.
You've been focused on Elon Musk, haven't you, Tom? Day after day, week after week, month after month. What did you make of yesterday? Let's just start there. Let's build it out a little bit. What did you make of yesterday?
He wants out. I mean, come on. Matt Levine, I thought was great at Bloomberg about this. We've got Dan Ives coming up, who's going to provide wisdom on it as well. He's playing by his own rule book, and to give him credit, he did it, I believe, within a 13D filing. He's allowed to do that.
Stock down 1.5%.
Did I avoid that question nicely, John?
I'm not sure you did. I think it's pretty clear what you think about it.
Did I do okay on Boris with Lizzie?
Yeah. Okay.
It was okay. Yeah. Like
where do you want to go with that story, Tom? The pressure's on him.
You're
he might
the
have to
expert.
leave.
I'm
no expert on this.
We're not Americans. We don't get it.
Tom, if I'm focused on one thing in the UK right now, it's the Bank of England. It's the Bank of England. It's not Westminster. Westminster's where all the theatre is, all the drama. The action for this market is on Threadneedle Street. It's Governor Bailey. It's the Bank of England.
This is crucial. ECB and Bank of England, are they overcome by yield? Does the bond market tell them what to do? I don't know about yield. They're
overcome by prices right now. The big fear for the ECB, let's be very clear, it's the big fear, the number one fear we've had for years with the ECB. This idea that inflation would start to build, would start to run away, and that the Italian 10-year yield would go with it. And if you're the ECB... Lisa, if the ECB in that world, what on earth do you do?
But this is hiking into weakness, and they're trying to deal with the fact that right now the price rises are unsustainable that people are feeling, and it's become a political issue, and it's an economic one as well.
How do we go from Elon to Boris to President Lagarde and Italian bonds? I've got no idea.
Surveillance is what we do. It's why
it's because we're still in different rooms and we can't get on the same page. Future's down.
We're not on the same page. We're in the same room.
Even if we're next to each other holding hands, we're not on the same page. And Nasdaq down 6/7 of 1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Boris Johnson is trying to draw a line under the controversy that's been threatening his leadership, but the scale of a mutiny against the British Prime Minister suggests his days may be numbered. Johnson survived a confidence vote by members of his own Conservative Party. Still, more than 40% of Tory MPs voted against him. Johnson now says it's time to get back to helping people with the cost of living. Hong Kong won't tighten coronavirus restrictions before the city's July 1st handover anniversary. That's according to Chief Executive Carrie Lam. There's been speculation that China's President Xi Jinping might attend the celebrations. Hong Kong's COVID cases have been rising since the city began rolling back social distancing curbs. Goldman Sachs warns that oil prices will have to go higher to solve the current market deficit. The firm says Brent crude will need to average $135 a barrel over the next year for global inventories to normalize by late 2023. That is about $15 higher than the current price. Brent already is up more than 50% this year. U.S. regulators are investigating whether crypto exchange Binance Holdings broke securities rules. It has to do with the firm's BNB token, which is now the world's 5th largest. The SEC wants to know if the initial coin offering in 2017 amounted to the sale of a security that should have been registered with the agency. Binance says it won't comment on talks with regulators. And Apple has unveiled the most significant overhaul to its popular Macbook Air Laptop in more than a decade. It features a fresh design, new colors, and a speedier processor from its homegrown line of chips. Apple showcased the MacBook Air at its annual Developers Conference. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There are a lot of things that are driving the earnings picture, and right now revisions have not been too negative. You need to see some wage rising, especially at the lower end. The question is really going to be how badly does that impact profits going forward, and when does that start to come through when people start talking about it on earnings calls?
Sarah Hunt, just brilliant yesterday, the portfolio manager at Alpine Woods Capital Investors from New York City this morning. Good morning. Futures negative on the S&P, on the Nasdaq 100, waking up to an equity market just trading a little bit lower, down 0.7% on the Nasdaq, on the S&P down 0.5%. Yields coming in a couple of basis points after moving 10, 11 basis points higher on a 10-year yesterday, just north of 3% right now at 3.0196%. And for anyone on Twitter watch, here we are at 38.90 in early trading. The spread, Tom, getting wider over the last couple of days, 54.20, the agreed price between Elon Musk and Twitter's board.
Got to dive into that. Twitter and Musk. We'll do that. Lisa and John want to talk to Daniel Ives. He's senior equity analyst at Wedbush Securities. But I want to take 30 seconds right now, Dan, to talk about the core of what I talked to Apple about on my visit to Cupertino years ago. And that is what's never talked about, which is the chip technology. The new M2 yesterday does 15.8 trillion operations per second. You know, Dan, it's not the toys, it's the underlying chips. Can anybody compete with Apple on chip technology? Have they left Intel and the others in the dust?
I mean, Tom, that's really the point yesterday. I mean, they're beating chip companies their own game. I mean, look at when you compare what they're doing to Intel, and I think they're controlling more of that ecosystem in Cupertino. That's really the key. And also remember, they're releasing new products at a time that the supply chain is the worst we've seen in 50 years. Just shows them flexing their muscles in terms of owning that ecosystem.
Lisa, I think the Musk story is so important that I think we got to jump to that. And why don't you do that? But I'm going to say this, folks, and it's been a hallmark of surveillance for 20 years. We believe in technology, and what Apple is doing, whether you buy, hold, sell on it, doesn't matter. It is stunning how they have leapt forward in operations per second. Lisa?
Yeah, honestly, I actually don't think that necessarily the Twitter story is more important from a structural market perspective. And Dan, I think that you've really highlighted how Apple is really on the front heels of this whole trend. But it is the one that's sucking up a lot of the oxygen in the room, at least when it comes to gossip. What is the goal here? Elon Musk clearly wants to walk away from 54.20. The board, how much do they have in terms of conviction to make him stick with it or pay the $1 billion breakup fee?
I mean, look, their backs against the wall because ultimately Musk is either behind the scenes talking down a lower price. And you see that in terms of where the stock's trading. 54-20, better chance of me playing for the Celtics in the championship than that deal happened. That's the view of the street. And then otherwise, there's a 60% chance he tries to walk away, pay the $1 billion. The problem there is the board. They'll fight him in court. And then really bruised and bad, this continues to sort of be a company that could blow in the wind, as it's a standalone public company. Board is in just between a rock and a hard place. And this is just a nightmare scenario. And the way Musk has dealt with it has clearly been a black eye, not just for Musk, but for Tesla stock.
Okay, so let's go there, because that's probably the bigger story, also longer lasting. Elon Musk's footprint and, frankly, his reputation. How much of a black eye has this been for him and, frankly, for Tesla?
I think it's been a near term. It's not a longer term issue, but it comes down to investors. You've started to see the Musk fatigue, frustration. They want to see him be focused on Tesla, on the supply chain, on the build out in China, all the zero COVID issues that have hurt them. And it feels like that narrative's changed over the last week, and I think that's why you're starting to see a bit of a tone change from Musk. And ultimately, that's really the key right now for Tesla investors. The last thing you ever wanted was the Twitter deal in the first place. And again, Musk woke up, it's cold feet, and the bot issue has clearly become a story of its own.
How complicated is this, Dan, given the fact that we not only have the breakup fee, we not only have the obligation on both sides, the potential lawsuit from the board, which may or may not happen because they might see it in their best interest to just let him walk away and not prolong this fight. But there also are Wall Street banks that have given him financing agreements. I mean, this has been actually a pretty involved negotiation. How much has to be done to unravel this deal?
Oh, I mean, this is a Rubik's Cube, times 3, right? I mean, this is good. They'll do business school cases, law cases on ultimately how this all plays out. Because as you've seen, I mean, the legal spider web around this deal is extremely complex. Obviously, I'm not a lawyer, but if you look at all the legal experts, that's the problem, right? And you saw the first shot across the bow yesterday. It all comes down to the stock's telling you something. It's telling you it's either a lower deal or he tries to walk. And again, Tesla is a much different situation. $400 billion plus has come off the market cap since the deal. And I think Musk has really started to, change his tune.
Dan, as I looked at Ron Josie's work at Citigroup yesterday on Amazon, and I really was taken back by the reaffirmation of 17% revenue growth at Amazon and the explosive EBITDA growth as measured pre-pandemic. What do you see now as the persistency of revenue growth of the major tech companies? Have they reaffirmed that, or is there a doubt to it?
Well, look, I think the strong have gotten stronger. I think especially when you look at the cloud theme playing out at Redmond in terms of Microsoft, what's happened at AWS in terms of Amazon, then of course Google, GCP, and you've seen beneficiaries of Oracle and IBM as well. Look, and no doubt, I mean, in this softer macro, you'll ultimately see numbers come down a bit. But I think right now there's a have and a have-nots. Enterprise, cloud, cybersecurity holding up strong. Consumer clearly seeing some weakening, but again, it's what's baked into these stocks. That continues to be the key, and that's why we're bullish on tech names, especially a lot of the large caps.
Dan, you went there. Let's end there. Warriors Celtics tomorrow, Game 3. What's the big call from you?
I think Celtics win this in 6. That's my call.
There you go. Tom, you happy with that?
Yeah, loving it.
Just one of those rare beasts you are, TK, from New York, but supports Boston sports
No,
teams.
I don't like the three-point shot. I just move the line back.
You don't like the three-point shot?
It's stupid. Move the line back and make everybody play inside.
Do you think that would make a difference to Steph Curry? Just come back further, Tom.
No, people tell me he's so good that
it's ridiculous.
Wouldn't matter. But I don't know. I'm bored with the three-point thing. I want him to go inside and play real basketball.
Good to know. Any suggestions for any other sports?
No, I just think I love the Tots New Jerseys.
Nice.
What do you call them?
I haven't seen that.
What do you call them?
You can call them kits. You call them jerseys.
We
call them
don't
whatever you want,
kits.
Tom.
What's your view on curling?
Curling, actually.
Tom has strong views on these things.
I'm strong. Now that you bring it up, there I was in Davos at Hotel Parsen. Great food. Thank you, Anita. And right there in the lobby, they got the curling thingy, the granite thing that Ferro used 3 years ago on the pond next door in the winter.
and almost broke my hip.
You did. You almost broke your hip, but the beer in the left hand saved you.
Let's thank Dan Ives and get me out of trouble quickly. Dan Ives of Wedbush. Thank you, Dan. Thank you, sir. On Microsoft, something we've missed so far this morning. Insider reporting yesterday, Lisa, they're slowing hiring across the company. That report follows the story of the last week, that they're pulling back some of the estimates on FX headwinds too. Something's building there.
And it's not just Microsoft, it's not just Amazon, and frankly, it's not just specific areas like retail. It's pretty broad-based in some of the areas that benefited the most during the pandemic.
The futures this morning, and good morning to you, down about 0.5% on the S&P 500. Whaley of BlackRock joining us shortly from New York. This is Bloomberg Surveillance.
The Fed has given very strong guidance about what they're going to do, but they've probably reached a maximum level of rhetorical hawkishness.
In the end, with inflation this high, it's very difficult for the Fed to change its reaction function.
I'm afraid the Fed's going to have to do more, and I think 50 basis points July and June.
The Fed is tolerant of inflation above 2%. So this is going to take time before we get to the point where the Fed really has to hurt us.
We're taking the optimistic case here that the Fed will be able to pull this off.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Target, we have a problem. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures down 0.7%. TK Target making a move once again.
Getting out front of it. Last time was a shock, and you saw the massive move down. I've got a negative 4.5% on Target as a first glance here. And what the headline's just breaking out right now, John. But what really this is about is inventory. They're not moving it.
Cutting their profit outlook. And Lisa, they plan, quote, pricing actions to cut high transportation costs as well.
I'll translate that for you. They're going to raise prices. They're going to raise prices across the board in order to offset some of the extra costs. They are not alone, and perhaps they are seeing the ability to pass along those costs. But the fact that margin compression is finally what we are seeing indicates not all of it, right? There is starting to be a little bit of pushback, especially for those staple companies. They are still holding the year's revenue in the low to mid single-digit range. But to Tom's point, Target shares down nearly 5% in pre-market trading.
This is all about margins, and they were down about 25% on May 18th. Tom, May 18th, what day is it today? June 7th.
Yeah,
May 18th they did
this is really, John,
June
this is
7th. What's going on here?
really important is how fast it's moving. And I'm going to suggest, John, that all corporations are going to adapt. What I'm going to guess is a hack is what they're going to do is start pricing their transportation costs with the new fuel regime that Jeff Curry's talking about at Goldman Sachs. Where is Uber? Where is Lyft? Obviously. But every company's got to factor in a new transportation cost.
These kind of lines get your attention, Lisa. Pursuing aggressive options to control costs. That's some aggressive language.
And they're dealing with an aggressively changing landscape. When you take a look at gas prices, I mean, if you look at diesel, for example, while you walk, it is changing in real time at different gas stations. And this is indicative of the pressures that companies like this are facing, especially as a lot of consumers are still demanding just-in-time delivery,
John,
and they're dealing with this. And I don't know how they get ahead of the margin compression that they're already expecting to see.
Is Europe any different? Does Lagarde have to deal with her own targets?
They're dealing with the same problem, Tom, in a big way. All these retailers are. What's interesting about this note from Target this morning is this second quarter pressure and the second half relief. They think they can do something about this, Tom, and things get better as the year progresses. But based on the guidance we've had from them in the last month, I think a lot of people in this market might be a little bit doubtful about what's coming.
Corporations will adapt, and the profit makers, as Dan Ives just talked about, will reign supreme. Clearly, that includes Target, the market negative 26, down negative 200. But, John, I'm going to just suggest what's really going on here, to your point, is the timeline is moving. You've got corporations with an autumnal mentality right now here in June.
Lisa, for me, has led the way on this. Lisa, when we started seeing this from the likes of Amazon, that we'd gone from being understaffed to overstaffed, to having not enough inventory, not enough space, to too much space, too much inventory, too much supply. That's the big turnaround. These corporations have been caught totally wrong-footed. They're set up for the economy of last year, except it's 2022, and they're facing down a weaker 23.
And the economy is changing so quickly, and consumer spending habits are changing so quickly. They cannot get out front, and now you add to this higher commodity prices and gas prices that will continue to climb, and this really dovetails to the Goldman Sachs note that we were talking about earlier. The persistence of $140 potentially Brent crude to try to dampen demand, to sort of equalize the supply-demand in equilibrium that we're seeing right now.
Target down 5% in early trading. If it feels like Groundhog Day, it was only May 18th that this stock was down 25%, cutting their profit outlook then, and Tom doing the same this morning.
I know we got to get to it, but just
Sure.
on another story, JM Smucker, smaller company, iconic in America. Good morning to the Midwest. They go from an 882 estimate down to 785 to 825. It's not just Target. It's not just the big companies we talk about. Everybody's modeling down, including SJM.
We'll keep building on this. Your equity market looks like this morning. Good morning to you. Down 0.6% on the S&P. On the Nasdaq 100, down 7 or 0.8%. Yields come in a little bit by 2 basis points after kicking high yesterday by 10 or 11. 3.02% is your yield on a 10-year. 118 right now on WTI. The team at Goldman, Lisa, they think we can push 140 in the third quarter.
Just sort of a really shocking statistic that has a lot of others on board with it. Today, what I'm looking at, 8:30 a.m., we get the U.S. trade balance for April. It is expected to be a little bit lesser of a deficit, but this is coming off of a record trade deficit for the United States on the heels of the stronger dollar, more buying power overseas, which is part of the reason why we're seeing imports increase to the degree that we have and that trade deficit deepen. 10 a.m., Treasury Secretary Janet Yellen is testifying to the Senate Finance Committee, ostensibly about President Biden's 2023 budget. How much will it really be focused on consumer inflation? We're expecting later this week that can CPI print. How much can she talk about getting wrong-footed, and how much will she talk and be questioned about the potential influence of the stimulus by this administration back in 2021? And at 1 p.m., an auction, U.S. Treasury Department is selling $44 billion of 3-year notes. This is the first one that will be affected by the runoff of the balance sheet, with less money from the Treasury Department reinvested in this market, John.
Lisa, thank you. We've got to pick up on Target all over again. Target cutting their profit outlook. Once more, the stock is down and down hard by 6%. Nothing like the move we saw just a couple of weeks back when we dropped 25% on earnings day. But here we go again with a similar story, down 6%. Wei Li joins us now, Global Chief Investment Strategist over at BlackRock. Wei Li, let's start there. How many more targets are out there? How much more of this is still to be seen that we need to discount in this equity market?
Well, so far, if you look at margin growth, and if you also look at earnings growth expectation, it's really elevated. It's really elevated, and margin, if you look at in the US and Europe, it's actually higher than pre-pandemic levels. And if you think about structural tailwinds that have led to margin expansion over the years, low rate, low production cost, low labor cost, arguably, and globalization as well, arguably they are stalling, right? So it is in our view that margin is at risk of further compression, and earnings expectation for this year is perhaps too rosy at this juncture, and that's why we downgraded developed market equity outlook to neutral, to stay invested but not chase the bear market rebound that we have seen so far.
Wei Li, I want to go back to Cambridge mathematics and to look at what the unexpected is. There is no one expecting a dollar breakout. Is the mystery for the rest of the year, given the cards dealt, that we could see actually strong dollar and legitimate dollar breakout in certain pairs, and particularly in the blended indexes like the Bloomberg Dollar Index?
While dollar strength earlier in the year has been behind some of the caution and also more risk-off tone earlier in the year, at this juncture, it's come back a little bit and staying at this range, which is our expectation. We don't think versus developed market currency pairs dollars could break out, but versus emerging market currencies, actually, we think emerging market currencies currencies could actually even appreciate a little bit more versus the dollar. So I guess here we are in a bit of a consensus group in that we don't expect a dollar to break out. But if it were to, then that would certainly paint a more risk-off tone for the remainder of the year, which could kind of impact market sentiment further. The risk obviously here is inflation, right? Thinking about how Fed repricing has reacted to inflation surprises and how that impacts the dollar. So obviously that's something that would influence both the dollar as well as the global risk sentiment.
Why are U.S. companies, Wei, going to have a harder time passing along the costs to consumers than in the developing world, if given the fact that there is that strength in the consumer? And that seems to be the implication in moving away from overweighting the developed world and going to EM.
Well, actually, if you look at earnings so far, yes, we have been of the view that EPS growth expectation is too rosy. It needs to come down. But companies have actually demonstrated reasonable ability, and I'm talking about in the U.S. as well as more broadly in developed world, ability to pass through some of the cost and demonstrating pricing power. So if you think kind of looking forward, the gap, like CPI is high, with 8 handle, but PPI is even higher in parts of developed world, right? So that margin story will play out, and that would impact kind of company pricing power and profitability outlook going forward. Companies are finding it's hard to pass through. They are trying what they can, but ultimately it's also a market cap story, and we think that it's going to be very hard to do that on a sustained basis, which is why we are somewhat cautious around earnings outlook as well as margin outlook.
Wei Li of BlackRock. Wei Li, thank you, as always. And some of the words of Wei Li there reflecting what we're hearing from Target this morning. Good morning to you. If you're just tuning in, the stock is down by 7.3%. It is the middle of May on repeat, Lisa. It was only a few weeks ago. And what strikes people this morning, I think surprises them, is the speed here, the speed that we're doing this all over again just a few weeks later.
And just to put this into perspective, Target shares are down more than 30% before today's sell-off. The shares now down more than 7%, nearly 8% more of a decline. So this is coming as a massive surprise, one revision after another in a fast-moving economic backdrop.
TK still heading lower, down about 8%.
Heading lower, and I can't give you any technical wisdom other than it has breached the day close low of May 24th. So we're really down to new low territory.
Equity futures heading lower too. We're down about 1% now on the S&P 500. Nasdaq futures down by 1.2. From New York City, for our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Boris Johnson has managed to cling to power. The question now is for how long. The British Prime Minister survived a confidence vote by lawmakers of his Conservative Party. 148 Tory MPs voted against Johnson. That rebellion was bigger than the one suffered by his predecessor Theresa May, who was then ousted as Prime Minister 6 months later. The US has warned Kim Jong-un there will be a strong punishment if North Korea conducts a nuclear test. Both Washington and a United Nations watchdog agency say there are signs that North Korea could soon set off its first atomic device since 2017. Kim's regime has been test-firing missiles at a record pace this year. Elon Musk is threatening to walk away from his deal to buy Twitter if the company doesn't do more to prove its users are real people. But Bloomberg has learned that at the same time, both sides have been meeting and the deal is proceeding. Twitter reiterated it will hold Musk accountable to the terms of his $44 billion proposal. The U.S. Securities and Exchange Commission is considering a change to stock market rules involving retail investors. Bloomberg's learned that trading firms could be forced to directly compete to execute their trades. SEC rules demand that investors get the best execution for trades. Kohl's is in exclusive talks with Franchise Group for a deal that would value the retail chain at about $8 billion. Franchise Group's offer is for $60 a share. That has Kohl's surging in pre-market trade. In February, Kohl's said it had rejected takeover offers because they undervalued the company. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
once you get to $5 on average nationally, that's a startling number, really, frankly. And we're probably going to see that during the summer. But there's so much pent-up demand. I think consumers are going to drive right through it. Though, as we go into the new year and people have released their demand to travel, different story, right?
Kathy Bosch-Janschitz there of Oxford Economics. The consumer getting squeezed, margins getting squeezed. For the second time in 3 weeks, Target cutting the profit outlook. It's dragging down equity futures just a little bit on the S&P 500 by 8 or 9/10%. On the NASDAQ 100, down a little more than 1%. The stock, Target, hammered again. Down as much as 10% this morning. Right now, Tom, down by 9.2.
Yeah, 145 was the intraday low that we saw on Target. 145 was the low we saw on May 24th, I should say. And here we are revisiting that again. What we're going to do is inform with specialists. Jennifer Bartusius is that senior analyst for Target Retail Staples at Bloomberg Intelligence, and we're thrilled she could join us here on short notice. Jennifer, you talk about Target is the best manager of the paradox of choice. Now they have to manage the paradox of inventories. You and I are brushing off our LIFO, FIFO textbooks. How do you manage inventories other than to move it out at a loss?
Well, there's really a couple of tactics that they're going to try here. One is they're going to continue to hold what they can, what they think they can sell at higher price, especially as we go into the holiday season. But markdowns are inevitable, and that's really what we're going to be looking at over the next quarter. And so that's really the push behind this profit guidance.
You mentioned on a long-term basis they have an exceptionally loyal store following. Will those people rally to the markdowns?
Absolutely. I mean, part of Target's allure is that they offer great products at a compelling value. And so markdowns in the eyes of a consumer are meeting a value need that is even perhaps more pressing today than it ever has been. So from a loyalty perspective, this probably enhances Target with their customers. It just doesn't help them on a financial basis.
Jennifer, how much of a micro story is this and how much of a macro one? In other words, is this just basically a harbinger of what Walmart and Amazon can expect?
Well, there certainly are some concerns, especially when we saw what came out of the Amazon and Walmart earnings, where they both also had elevated levels of inventory. Part of this is the consumer and pulling back and changing the pattern of how they're spending and changing quite rapidly and pulling away from those more discretionary items. It's hard to predict. And so while some of this issue is self-inflicted from these large retailers, some of it is really just being victims of circumstance and the rapidly changing consumer. And now they have to adapt their operations in order to stay in step with where the consumer is and get rid of this excess inventory.
But to drill down a little bit more, Jennifer, there were accusations that companies, once again, retailers, were emphasizing growth over profits, getting greedy, trying to get ahead of that, building inventories more than they otherwise would have to. Is that going to shift in terms of how they're going to act going forward? Or is this basically going to be viewed as unavoidable and, frankly, a dueling picture having to do with a pandemic?
Well, I think that to a degree, I agree that it is unavoidable. I do think that there was not necessarily an intent to manipulate things. I do think that there was a view of the market that they needed to ensure that there were items in stock to help keep consumers calm following the pandemic, and that we needed to have some stability in the supply chain. And the only way for retailers to do that was to enlarge their inventories so that they would be sure that they had goods on hand. Now, did they go too far? Time will tell. But I think that in part of this, is an attempt to make sure that consumers still had access to the goods and services that they needed. But there will be some ramifications that I think we're going to see flow through second quarter and perhaps even into the second half of the year.
So, Jennifer, that's what I want to talk about here. I'm trying to work out what we're discounting. Are we writing down the second quarter, writing it off in some aspects, or writing down the whole year because we don't trust the guidance from this company anymore? They've made 2 points this morning. One is on the margins for this quarter, the current quarter. Then they see things building back out in the second half. Jen, can I get your view on that? What's happening now and why they think it gets better as this year grows older?
Well, what's happening now are going to be the markdowns, and that will take a huge and short-term hit to the company. I think when they're looking out at the rest of the year, they're trying to adjust their plans. We have back-to-school season coming, which is a huge season for these retailers, and we have the holiday season, and so when they look at the back half of the year, we're also going to be cycling past the initial phases of the high inflation from a year ago. So the picture does look a little bit better second half, but it really will come down to how well they're managing their inventories.
Jennifer, I took the CFA Level 1 exam with, I think, 3,000 people in an ugly auditorium in Boston. And when I got to the change in working capital questions, there was a sudden silence across the entire room. I butchered it. Provide clarity here. Is the blunt instrument to managing a change in working capital through inventory reduction that you axe some of 450,000 employees?
Well, I don't know that they're going to axe a large number of employees. I do think that there will be a very tight view in terms of additional hiring for the rest of the year. So traditionally, these companies hire seasonal employees as we head into end of back to school and beginning of holiday and through the holiday season. I think that will be radically different this year. I do think that there are going to be a lot of eyes watching working capital, but I would be surprised if we saw massive job slashes in order to make a difference.
Jennifer, thank you. Jennifer Bartashis there.
Lights out.
Breaking
Thank
down
you.
Target. That stock breaking down once again, down by more than 8%, Bramo. Not pretty for that company over the last 3 weeks.
And you wonder why things are moving so quickly, that they have to do so many revisions right after one another, that frankly, this is probably why shares are down as much as they are. What's next? How many more times are they going to have to revise downward? Why are they not getting ahead of this story and just giving some sense of finality to the revisions downward? And is this going to be a precursor for others to come?
So this is the first move on a stock, the early move, the knee-jerk reaction. I'm going to be interested to see how this closes a little bit later. How much faith people have, Lisa, in this idea that we actually get the second half numbers that Target's calling for, or whether we're overwhelmed by doubt because we're conditioned by what's happened in the last 3 weeks that maybe this ain't it.
Frankly,
there's more to come.
The language in this release didn't exactly engender confidence that they have a clear sense of what's ahead, because things are moving too quickly. I mean, what if gas prices take another significant leg higher? How much more are they going to have to jack up prices? And frankly, what is the consumer tolerance going to be to absorb some of those price increases? What do they call it again? The aggressive price adjustments?
Something like that. Tom, can you imagine Jeff Curry's world kicking in over the next 12 months? I'm not sure people are modeling that one, are they?
I do think within big box retail, the price of a gallon of gas is a really, really key idea. John, well, that was a tour de force with Jennifer. That's everything of what we're about, which is, John, it really talked about how a CFO looks at how do you clear this. I'm going to be blunt. I'm way more optimistic than the two of you that Target can clear this out by Labor Day.
I'm not being pessimistic or optimistic, Tom. Just raising the questions I think a lot of people are asking this morning.
I'm more optimistic on their ability.
Live from New York City this morning. Good morning to you all. Front and center, Target once again cutting its profit outlook for the second time in just 3 weeks. That stock, just an example of a much broader worry for this market. Have we fully discounted the profit pain that might be around the corner in this equity market? Futures negative, just off session lows. We're down about 0.8% on the S&P. On the Nasdaq 100, we're down by 1.05%. Talked a lot about that relationship between equities and bonds. Bond yields high yesterday through last week too. Up 20 basis points last week. Yesterday up another 11. This morning we look like this, 2s, 10s and 30s. Your 10-year yield comes in just a little bit by a couple of basis points, still north of 3 though. Your yield on a 10-year right now 3.0178%. You want to see a bigger move? Look down under in Australia, a breakout at the front end of the yield curve as we get a surprise from the RBA. Just 3 of, I think, 29 economists looked for a 50 basis point move. The 50 basis point move is what we got. At the front end, we're higher by 17 or 18 basis points. When you look at the currency, just bear in mind, Tom, today is a stronger dollar day. So that's contributing to this weakness we see in the Aussie. But it's a third day of it, and it raises the question for the ECB. If you get some kind of upside surprise from the ECB through this year, Is it currency positive or currency negative? And Lita and I, Tom, have had that conversation, that debate through the whole of this year.
And what Global Wall Street does, folks, is they go up the Pacific Rim to Aussie China, but particularly AUD JPY. Not out the new strength, John, but definitely Australia picking it up against a very weak yen.
Bramo, the appetizer, maybe, for the ECB in 2 days' time.
Especially because it follows what the Bank of Canada did. Now this bank, Australian bank, now we're dealing with how does the ECB handle expectations baked into the market of a 50 basis point rate hike at one meeting at some point this year.
For a story moving so quickly, the ECB just taking its time. Hardly anyone expects them to make a move this week.
Right.
It's just setting the stage, laying the groundwork to do something later in the summer. It's been a while. That's your cross-asset price action. Let's get some single names, and top of the pile remain. There is only one.
Yeah, John, it's Target basically moving everything here in this market. You talk about that guidance lower. I really just want to put this into perspective. Just about 3 months ago, most analysts were expecting margins of about 9.5% on the year. Target, of course, guided down to about 5.3% just 3 weeks ago, as you pointed out. And now we're sitting at about 2%. And that's a big part of the reason why you're seeing the shares down about 9%. This isn't necessarily a demand story. The demand is certainly there. But you talk about some of the operational issues and some of those margin pressures that these companies are having a hard time navigating. There's a broader discussion, of course, to be had about that bullwhip effect of trying to sort of manage supply, manage demand, and sort of put it all together in a way that's profitable to the bottom line. Brian Cornell, he's not really doing that, at least not yet here, and investors are really punishing this stock. They're taking it out on Walmart, which is down about 4% on the day. Amazon also sliding here, down about 2%, and pretty much everything in that big retail space, from the dollar stores all the way on up to the department stores, right now under pressure here in the pre-market. Now, we also did get some earnings out of J.M. Smucker a little bit earlier this morning as well. They also talked about a lot of those same margin pressures, and a company, of course, that doesn't have nearly the same pricing power as some of those big box retailers. J.M. Smucker, whose shares actually have been getting hammered over the past few days, now down another 3% here in the pre-market. Kohl's also dealing with a lot of the same issues. Those shares higher by about 9%, but that's largely, Tom, because of the escape hatch that this company is looking for, now in a tentative agreement here with the franchise group to potentially sell off this company. Yeah. And Peloton, of course, trying to get it back on track. They actually got a new CFO who they hired, Tom, from Amazon. So at least for them, that's looking pretty good.
Romaine, thank you so much. Sure. On a close today, a look at retail, including Target. Right now, we migrate to fixed income, and we do it with Mark Cabana. He is head of U.S. rate strategy, Bank of America, writing a very wonderful sequential note on what is to come for price and yield. Mark, let's get to the philosophical first. You say this is a Fed that is dovish at its core. Are they going to blink?
Not yet. We do think that they're dovish at their core because ultimately what the Fed is trying to do here is achieve that elusive soft landing. It's going to be difficult for them to do so, but they know that that's what they're after. And as a result, once they get rates into the range of 2 to 3%, which is their perception of nominal neutral, then they're going to probably think about slowing things down a bit. That's very consistent with our view that the Fed will be delivering 250 basis point hikes in the next two meetings, but then ultimately downshift to 25 basis points. Maybe disappoint a market that seems to be believing the Fed is going to go more aggressive.
Away from your sophisticated trades, our viewers and listeners are hammered by yield up, price down. And you say have the courage to own duration, get out there and get in the game. How exactly do you get in a game where on full faith and credit you have a drawdown of a negative 12%?
Yeah, so we think that what investors should be doing here is recognize where we are in this economic cycle. We're in the later innings of this. We're going likely to see an economic moderation and a tightening of financial conditions, which is exactly what the Fed needs to see in order to bring inflation lower. And as that happens, what investors should be doing is they should be looking to diversify out of risk and into safer assets that typically benefit when we are in these late stages of an economic cycle. And as a result, that just means diversifying away from equities and credit into more safe type of fixed income alternatives. And we do think that that's going to benefit the U.S. Treasury market as we get to levels around 3%, maybe slightly above 3%, because it makes it increasingly easy for investors who are managing multi-asset portfolios to diversify and make sure that they get some protection in case we do start to see a more rapid economic slowdown.
Which is a reason why we've seen buying come in around that 3% mark. I am I'm wondering about your interpretation of what we just got out of Target and this real margin compression that we're seeing and how that really feeds into the Fed's view. Does this encourage them to keep going with rate hikes because of how much the consumer is feeling inflation, or does it actually point to something more like a slowdown and give them more breathing space?
Well, they know that they have to get inflation under control. And likely one of the challenges that Target is having is trying to manage around inventory, recognizing that costs are rising and that they need to pass along some of that to consumers. But knowing how much they can pass along, how that impacts inventory, and then trying to figure out how their demand is going to be impacted by that is a very, very tough calculus. And so for the Fed, I think that they recognize, look, they are missing on their inflation mandate. They need to get that under control. They're going to be hiking reasonably aggressively at least the next two meetings, and then probably guiding the market to expect further rate hikes. Now, what that's going to do is it's going to help tighten financial conditions, cool demand, and we do believe that that will ultimately increase demand for fixed income as investors allocate, again, out of risk and into safer assets.
When you're coming up with a call for the Fed and these macro proclamations about where the bond market is going to go, how much are you looking at the resilience of the consumer, on the ability to absorb some of these price increases, and frankly, their willingness to continue to spend?
Yeah, so far we've been very surprised by the resilience of the American consumer. Our firm's credit card data does indeed show that there's been a lot of resilience, especially on the low income spending cohort. We're watching this carefully to see if there's any cracks, but right now we haven't really seen them. And that just makes us more confident that the Fed is going to be delivering these hikes. They will be slowing down later this year, but they're probably going to go, in our base case, beyond what the market is currently pricing. Not necessarily getting there super fast, but in the second half of the year, really in the third and fourth quarters, begin to slow down these pace of rate hikes. And ultimately, we think get to a level that's about 20 or 30 basis points above what the market is currently pricing, at around 3.5% by the middle of next year.
I look, Mark, at where the yield is right now. And the simple issue is we've popped above a 3%, 3.02% on the 10-year yield. What's your view out 1 year on that? I mean, somebody needs to know a single point B of A guess.
Yeah, so look, our forecasts have the 10-year at the end of this year at 3.25%. It's a single point in time estimate. It's awfully difficult to have a lot of confidence around that. But we do think that there's modest further upside in yield from here. Now, that said, we've recognized that given how the market has recently behaved, the risks are probably skewed to the downside on that forecast.
Interesting.
And even though we think that our forecast is slightly above where the market is today, that doesn't prevent us from believing that duration is not a bad addition to investors who are looking for some protection, again, against that economic moderation that is likely ahead of us.
Hey, Mark, awesome. As always, Mark Urbano there of Bank of America Global Research. As I'm just listening to Mark, just working through some research from Michael Purvis at Toolback, and Tom, I know you've read the same thing. He's looking potentially for what could happen if we break 325 on a 10-year yield, which was the 2018 high.
Right.
Opens up a higher range in his mind, potentially a quick jump to 375 or even 4. And he folds in the crude effect here. And ultimately what he's saying here, a sharp jump in crude will, we think, be the catalyst for a sharp jump in interest rates. And this is the Jeff Curry, Goldman Sachs view of the commodity market folded into the Michael Purvis view of the bond market, Tom.
What's great about Purvis is it's not that it's difficult to read, but the guy is nuts. He puts things together, and what he's putting together here, John, is a 30-year look at the guesstimate of inflation and then how that links in to that sustainability of higher oil prices.
I'm sure he can't wait to come back on, Lisa. The guy's nuts.
It's great.
That's going to be his introduction next time he appears.
It's a very eclectic note.
Well, you can join the club because clearly he's not alone in that capacity. I do think he is, though, alone perhaps in thinking that 10-year yields could go up to 4%. At least if you look at the reaction in the bond market today, you're actually seeing it lower and really kind of giving some credence to Mark Urbano's view, at least from the market.
Well, there's an if here, right? There's an if. And the if is what happens with crude if it gets to 150 and maybe beyond in Michael Purvis's mind. And that's the lead story for me this morning, just waking up and poring over those Goldman notes yesterday evening from Jeff Curry and the team, Tom. This idea that we can strike 140 in the third quarter on Brent.
Yeah, well, Target's going to strike 140 and 144. John, Neil Dutta says, John, CPI Friday all of a sudden becomes a lot more interesting. And Mr. Dutta at Renaissance says, watch apparel prices. That goes right into inventory. Move it or lose it.
It's a break of 145 on target, 144.75 and down by 9.2%. Some of that weakness in that stock dragging down the S&P just a bit, down 0.8% on the S&P 500. From New York City for our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Boris Johnson is trying to draw a line under the controversy that's been threatening his leadership. But the scale of a mutiny against the British Prime Minister suggests his days may be numbered. Johnson survived a confidence vote by members of his own Conservative Party. Still, more than 40% of Tory MPs voted against him. Johnson now says it's time to get back to helping people with the cost of living. Shares of Target are falling. The discount retailer cut its profit outlook for the second time in just 3 weeks. Target's trying to ease a surge in inventory by marking down more merchandise and cancelling orders. Operating profit will amount to about 2% of sales in the current quarter. That's well below the 5.3% target estimated 3 weeks ago. Hong Kong won't tighten coronavirus restrictions before the city's July 1st handover anniversary. That's according to Chief Executive Carrie Lam. There's been speculation that China's President Xi Jinping might attend the celebrations. Hong Kong's COVID cases have been rising since the city began rolling back social distancing curbs. And tourists visiting Japan may be sent home if they don't follow the rules on wearing masks and sanitizing their hands. They also must buy private health insurance. Japan is set to allow package tours starting this Friday. Borders have been mostly closed to tourists since early 2020. Apple has unveiled the most significant overhaul to its popular Macbook Air laptop in more than a decade. It features a new, fresh design, new colors, and a speedier processor from its homegrown line in chips. Apple showcased the MacBook Air at its annual developers conference. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There's no real reason to be worried about a recession. There is some slowing in the picture. But the other thing is that part of the reason we're getting slowing is high inflation. And I think the combination of high inflation and tight labor markets is starting to change the inflation process, which over time is not good for the sustainability of this expansion.
What did someone say to us yesterday? The hurricane at JP Morgan downgraded to a light summer breeze. Bruce Kasman there over at JP Morgan. Saying something different to what we heard from the CEO last week, which is fine because one runs a company and the other guy is running research. Equity futures down 0.8% on the S&P 500. On the Nasdaq, we're down around about 1%. Are we in for a slowdown, maybe even a recession? It depends who you ask and what stock you look at. Target cutting its profit outlook for the second time in 3 weeks. That stock is down 9%, Tom. You ask a retailer, there's a struggle, clearly. But if you ask an airline right now, Tom, how the consumer is, they'll give you a very different answer.
They will. I mean, that's right now. I'm watching prices, John, in New York to LAX has just started to creep down a little bit. I'm watching that every day.
And the plane's still full, Tom. It's still full.
Yeah, but it's out there. And Cabana said in his note, there's every shop has a different view on this coming slowdown. We'll have to see as well. We're watching Target here this morning with some good perspective coming on radio and television through the morning. Right now, and this is a joy, John and Lisa are going to talk to Vincent Reinhart of Dreyfus and Mellon, their chief economist, about the moment at hand. He's a little concerned about communication at the Fed, but I want to talk about the communication at the beginning of the panic. Reinhart and Reinhart, Carmen Reinhart, your wife who's at the World Bank, wrote the mother of all essays of this pandemic on the pandemic depression. And we are now, Vincent, at a point where, as you said then, the global economy will never be the same. If I may, can you expand on that and tell us how this global economy will never be the same as we are now somewhat out of this pandemic?
Well, let me first admit where we were wrong. Back then, we were worried that there would be a long, dramatic, and persistent decline in output, And that was because there'd be insufficient policy stimulus.
And policy showed up.
Worrying about policy stimulus was not that relevant, and that's the really good news. But what's the other key message? That is economic dislocations, whether it's a recession or a depression, leave lasting scars. They leave lasting scars on balance sheets. They leave lasting scars on people. People act differently coming out of severe economic dislocations.
So let's go to Lawrence Summers and Olivier Blanchard and talk about hysteresis, which is when you're out of the system, you never get back. Are we so much out of the system that you have to mark down GDP and the Fed maybe will be more dovish because they will have to mark down due to our pandemic hysteresis?
Well, a big lesson. And by the way, Tom, what is the most costly thing coming out of a recession or a depression? It's the lessons you take away from it, because that influences how you think about behaviors for the next couple decades. So we're all
depression babies like our parents.
Exactly.
Is that what's going on? Lisa, you're too young for this, but Reinhard and I grew up as depression. We had parents who were depression babies. It was terrible.
So that's really exactly where I wanted to go. When do we start to see consumers pull back, especially given the fact that it seems like Target and perhaps others are not able to pass along the price increases as rapidly as they'd like?
Another message of the paper Tom was talking about is the shock was very regressive in incidence, i.e. it really hit low-income families harder. So when you talk about the consumer, you got to ask who's got the wherewithal to withstand a slow patch in the economy. Remember, probably there's still about $2 trillion of excess savings socked away, given all the government programs in 2021. Those households will be able to ride out the shock. However, lower income households are going to have a harder time, and we are going to see some pulling back. But what's the key metric right now that tells you households aren't really that worried about recession? Saving rate is low. If people were worried about their income prospects, they wouldn't be spending so much out of their income.
Which might be a good thing and might be a bad thing, especially because the quits rate is going up too. So it's not exactly as though people are particularly concerned, but maybe they should be, is what some people are saying, especially as they forecast the potential for recession out in 2024. When do gas prices become recessionary? When do oil prices higher actually become disinflationary rather than inflationary, as some people are projecting?
So I think the person asked is Jim Hamilton of UCSD, who's done the important work on oil prices and economic business cycle. And the plain fact is, when oil prices move away from where they've been for a while, when they get salient in household decisions, when they really get your attention, that's when they matter for economic activity. And guess what? We're long past that point. Yeah. It is number one concern among households. It's got to be crimping household spending, particularly for those who get hit harder, lower income households.
Vincent Reinhard, Jerome Powell is not going to show up as I'm sure Coach Alan Greenspan to Humphrey Hawkins or whatever it's called now and say, frankly, I don't give a damn. But it is a gone with the wind market. You say Scarlett O'Hara is sitting at the Fed table where tomorrow is another day. Is it a day with too much communication? Is this a Fed talking way too much versus a silence in the halls when you were there for 24 years?
Well, I'm going to date myself, but I will admit one of the formative books coming into the Fed, which was the big book of the late 80s, was William Greider's Secrets of the Temple. That talks so much about
Are they talking too much now? Lisa gets up and does our brief here. John, we're in a quiet period, right?
We are. No Fed speak, Tom. That's
no
the good
Fed
news.
speak. Do you want that? Do you want a permanent quiet period?
No.
Except for Chairman Powell?
No. You got to listen to the chair. There are opportunities for members to talk. Part of the genius, if it is a genius, of the construction of the Federal Reserve System is to let a diversity of opinions flourish. And if there's a diversity of opinions, you want to hear that. However, it's not helpful when everyone's talking and everyone's reading the same page of the hymnal. How much information did you get from Fed speakers over this intermeeting period? What they told you was the summary of what would appear in the minutes, and that Chair Powell already told us in the press conference. What I worry about is their communication strategy is fractured. Gradualism, what they're doing right now, we're going to do 50, we'll do 50 for the next couple meetings, is about very near-term guidance because tomorrow's another day. Listen to Chair Powell at the press conference. He doesn't want to talk about hypotheticals and doing things in the future. But then they publish the summary of economic projections that gives a sense of where interest rates are going to be 5 years from now. It's not consistent.
I'm afraid to ask this. Let's go with it, Vince. John, have you seen Gone with the Wind?
I haven't, Tom. Not really my style, those kind of movies.
You know,
we're out of time, too.
By the way, you're exactly right. It's not politically correct
Can you see
anymore.
Lau Brainard turn to Chairman Powell and go, "Sir, you are no gentleman"?
No. Vincent Reinhart, thank you. Tom, you've got to keep an eye on the clock. You're out of time. Vince knows more about the clock than you do, apparently, which is why he stopped talking.
Gone with the Wind.
Futures down 0.8%. From New York City this morning, good morning. This is Bloomberg.
While the recession risks have gone up, the U.S. recession is still not our base case.
I think you'd have to get hit by much bigger shocks to really talk about recession anytime in the next 12 months or so.
It's really financial conditions that affect the economy.
I'm not sure we've seen the higher yields. We may go back and test those.
The fundamental assumption behind all of our modeling is the idea that we're going to see a material slowdown in economic growth but skirt the recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, on a most eventful day. John, we're supposed to get to CPI Friday, but on the way to it, we've got to look at corporations adapting and adjusting. Target adapts again.
One stock, Target, down 8.7%. One fear that it's more than just Target. That's the problem right now. People are spooked by this, Tom. You see it from Target, from Walmart, from others as well. Margin pressure. Is it just the retailers, or will others follow?
Well, it can be the others follow, but let's say they clear out their problems right now. Let's be optimistic about that. John, it's to me the then what of, say, autumn and into 2023.
So, Tom, in their forecast, they are optimistic. They see the pain in Q2. They think things get better as the year grows older. The problem is, for a lot of people in this market, they've been conditioned by the last 3 weeks. This is the second time in 3 weeks that Target has done this. And, Tom, if they've been wrong about the last month, are they right about the second half?
The Fed sees us, Vincent Reinhart, just talking about a naturally dovish tilt, or rather it was Mark Cabana, Mark Cabana talking about a dovish tilt. John, does the ECB have a dovish tilt the way interest rates are moving in Europe?
I think, Tom, to be fair, I think both the ECB and the Federal Reserve still has a dovish tilt, and this is why. Don't listen to them. Just look at where rates are relative to where inflation is. That's pretty dovish. And if you landed from Mars back on Earth and looked around at where inflation was and where the policy rate was, Tom, you would say that these central banks were still very dovish.
Lisa, it's a gallon of gas higher.
And frankly, what does this do to the corporate profits? This is really what's feeding also into Target. But also, at what point does this crimp consumer demand? At what point are we looking at the rate hiking fears of the first half of the year translating into profit fears, into a consumer with less resilience? And that, I think, still remains an outstanding question.
John, Jason Furman writing brilliantly in the Wall Street Journal today on a compare and contrast. Wage growth in the United States up 6%, in the EU up only 3%. John, I don't buy it. The Fed and the ECB have the same problem, given what we see from Target or the Target of Germany.
They don't have the same problem. The labour market here is stronger than the labour market there. The other thing I'd point out, Tom, don't compare headline inflation in both regions either. Look at core inflation. Core inflation in Europe is much lower than core inflation in the United States. In the United States, we have a much broader problem with price pressures.
We're going to see that on Friday. You need to stay with us today and on through Friday to see about the inflation opinions of our good guests on the equity market here in a moment. John, I don't even know where to begin on the data. Why don't I begin with Target down 9%?
And equity's down too. On the S&P, on the Nasdaq, we're down 0.8%. On the S&P 500, on the Nasdaq 100, we're down a little more than 1%. Yields higher. The story of the last week. The story of last week, up 20 basis points. The story of yesterday, up 10 or 11 this morning. Down about a basis point to 3.027%. And in the commodity market, crude, negative 0.2%, 118. And just some big forecast coming out of the team over at Goldman, Tom. Looking for 140 on Brent in the third quarter, looking for 137 on WTI in just a few months' time.
John, maybe you know more about this than I did. Did Ed Morse capitulate yesterday?
A little bit.
Yes,
a little bit. I wouldn't call it capitulation.
Okay, thank you.
Maybe marking to market a little bit, Tom. Just a bit.
Oh, okay. I don't know where that goes. I'm looking at yen, folks. For those of you on Global Wall Street, I'm sorry. This is a more sooner story than what I'm hearing from our guests. A 132, almost 133 yen is an immovable force for the mechanics of the Pacific Rim. Right now, an immovable force in the equity market. Sam Stovall joins us, Chief Investment Strategist at CFRA. Sam, what is your tone of your mid-year review?
Well, good morning, Tom. I think the tone is one of confusion, as you can hear just by your conversations with Jonathan, et cetera. From an economic perspective, our forecasts are that we are not going to be falling into recession anytime soon, but history tends to disagree. Whenever the last 5 times since World War II that we have seen headline CPI rise above 6.5%, which is one standard deviation from the mean, we have always fallen into recession and been accompanied by a bear market.
Sam, this is the expertise of CFRA and all that you do with your STAR system, which is what corporate officers do when they're handed a slowdown, margin compression, maybe even the gloom of a recession. Don't they act faster than what we expect?
Well, the management does tend to act pretty quickly. I mean, just take a look at what the guidance has been from companies to analysts. Just looking at second quarter earnings revisions today as compared with where we were on March 31st, basically you're seeing consumer discretionary having second quarter revisions downward by more than 16%. And in a sense, what you're finding is these companies are very quick to get out there to say what the problems are likely to be, to let the stock price then reflect those revised numbers so that when the reports do come in, this will probably end up being a quarter in which the actuals come in a slight bit better than forecast, as we have seen in the 51 of the last 52 quarters.
Wait, this is important, Sam. You think that what the companies are telling us accurately reflects the scope of the pain and perhaps gives a floor to some of these valuations that possibly could lead to buying opportunities?
I think that by assuming that a floor is being put into place, I think is a bit premature. I think that what these companies are doing is acknowledging that there is weakness ahead and that you have some companies that are saying, you know what, we're not even going to offer guidance because we just don't know. So I think that what is happening is that you are continuing to see that floor be revised downward, but I don't think that ends up being a very solid floor.
So Morgan Stanley's Mike Wilson actually pointed to this as one of the reasons for more of a sell-off and a potential 3,400 target on the S&P later this year, because when those second quarter earnings revisions come out downward, people will reset. Do you disagree?
No, I don't, because when you look back to World War II, you look at PE revisions during bear markets. Actually, it is about a 33% reduction in PE ratios, and that would bring the S&P 500, based on 2022 earnings estimates, down to 3,400. If you also look to a couple of technical indicators, such as Fibonacci retracements, the head and shoulders pattern, et cetera, that implies targets around that area as well.
Okay, Sam Stovall, CTA, technical analyst. Sam, are we in a bull market rally amid a bear market, or has there been enough catharsis to call a bottom and a new form of bull market?
I think that we're in a rally within a bear market. I think that this market could end up, as I mentioned, right now we just got back to average PE on forward 12-month earnings. And typically we traded a discount, significant discount, when all is said and done. So too many people, in my opinion, believe that the Fed will be able to engineer a soft landing as in 1994. But when you see the Fed funds rate 7.5 percentage points below headline CPI at the beginning of the rate tightening cycle, usually it's the reverse, where Fed funds is actually higher than inflation at the start of a tightening cycle. I think the Fed has a lot of catch up to play.
Given that, and given the fact that basically people are looking at very different outcomes in a downturn of what happens with benchmark yields, how are you using duration as a ballast or not, given what you expect to happen in the next couple of months?
Well, that's assuming that I know as much as you just asked. I would tend to say that basically when we're dealing with interest rates obviously are the key to intrinsic values. Our estimate is that, yes, we do trade above that 3% level for an extended period through the end of this year, and that will continue to put pressure on stocks. And it's usually the growth areas, in particular, consumer discretionary, communication services, technology, that feel the greatest pressure in terms of PE contraction during rising interest rate environments. And not surprisingly, that's why we see the inflation hedge, energy, as well as materials, and then also taking a look at staples and utilities as being among the stronger performers right now.
Sam Stovall of CFRA. Just on that final point there, Lisa, from Sam. And Sam, thank you. On the bond market, just hearing more of that. Heard it from Morgan Stanley yesterday, this idea that we stabilise with a 3 handle. And we mentioned yesterday when we called up with Vishy Tirupatoor that maybe that sounds unusual because so many people come on the programme and talk up this idea of slowing growth next year, which you'd think would bring down yields. I was just looking at the forecast on a terminal for next year on a 10-year. Q3 next year, 324. That's your median forecast. 324 for Q2 as well. So we're looking for that 324 range through the middle of next year.
And how much is this driven by real yields, right? I mean, this isn't necessarily that people are going to have such a different outlook for growth over the longer term or think that there's going to be more of it, but rather that the Fed is not going to be providing the same sort of stimulus. Oh, and by the way, when do we start talking about stagflation again, that kind of trend, stagflationary types of wins that really push back against growth, but allow inflation and yields to remain higher?
Or, John, with a vengeance, with slowing international growth, and maybe China doesn't pop like it's supposed to pop, money flows to the United States, price up, yield down, providing stability.
Dollar stronger, Tom. And whose problem is that this time around?
It's Japan's. Japan. Every pro I talk to, Japan is the elephant in the room because they're playing by a different rule book. They're sort of the Elon Musk of FX. They're playing by a different rule book than everybody else.
You want to call Kuroda the Elon Musk of FX?
No, I call Elon Musk the Kuroda of technology.
Okay, just to be clear on that. Yeah. TK, on a serious note, what on earth can they actually do if that's what we get more of? Yeah, what can they do?
They're going to have to do what they've done. They've got to expand the x-axis out a decade and go as deliberate as they can.
Equity's down 0.9%. There goes your interview with Kuroda, Tom, when he steps down.
Yeah, but my one with Elon Musk is front and center.
Yeah, very much so. Elon can't wait for that one. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Boris Johnson has managed to cling to power. The question now is for how long? The British Prime Minister survived a confidence vote by lawmakers of his Conservative Party. 148 Tory MPs voted against Johnson. That rebellion was bigger than the one suffered by his predecessor, Theresa May, who was ousted as Prime Minister 6 months later. The US has warned Kim Jong-un there will be strong punishment if North Korea conducts a nuclear test. Both Washington and a United Nations watchdog agency say there are signs that North Korea could soon set off its first atomic device since 2017. Kim's regime has been test-firing missiles at a record pace this year. And shares of Target are falling. The discount retailer cut its profit outlook for the second time in just 3 weeks. Target's trying to ease a surge in inventory by marking down more merchandise and cancelling orders. Operating profit will be about 2% of sales in the current quarter. That is well below the 5.3% that Target had estimated 3 weeks ago. And Elon Musk is threatening to walk away from his deal to buy Twitter if the company doesn't do more to prove its users are real people. But Bloomberg has learned that at the same time, both sides have been meeting and the deal is proceeding. Twitter reiterated it will hold Musk accountable to the terms of his $44 billion proposal. And Kohl's is in exclusive talks with Franchise Group for a deal that would value the retail chain at about $8 billion. Franchise Group's offer is for $60 a share. That has Kohl's surging in the pre-market trade. In February, Kohl's said it had rejected takeover offers because they undervalued the company. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
the key metric right now that tells you households aren't really that worried about recession, saving rate is low. If people were worried about their income prospects, they wouldn't be spending so much out of their income.
That's one take. Vincent Reinhardt there, the chief economist at Dreyfus and Mellon. Here's another take, $4.92, your average gas price in America right now. Tom, I missed that. That's a big move in the last week. We're getting closer to 5.
John, this is convexity, acceleration. It's not the number, it's the way we're getting there and getting there rapidly. I really did not expect that 2 weeks ago.
And we're looking for 6 over at JP Morgan by the end of summer, Tom.
You know, there we are. Brent
Maybe
crude,
things get worse.
Yeah, Brent crude 119 right now, down $1 from where we were yesterday. Lots going on this morning. Let's jump to it now. Oliver Chen with us, senior equity research analyst at Cowen, who usually talk to him about fancy sweatshirts at Celine. Not today. We talk Target, and we note that he teaches at Columbia Business School on retail as well. Oliver, I want to talk about the reality of Target, which is the Chloe ankle strap sandal, is usually $16, $17, and you can go in there and for the kid buy it for $13.59. If they lower that puppy down to $11.99, will they sustain the traffic that you say is required?
Well, Tom, what we have here is the consumers repositioned very quickly. So we had a cooler April, unfortunately. Anniversarying the stimulus was also an issue. And these markdowns taking place now are critical. Speed is the name of the game in retail, and Target is doing that now. The consumer shifted faster than they expected in terms of the consumer going out, requiring suitcases instead of swimsuits, and big and bulky in home. That's been under pressure too. So doing this quickly is a positive action, and markdowns will occur in the marketplace now this quarter. We're looking forward to a better back half, and Target and others execute well for back to school. Back to school should be pretty good. We are seeing a bifurcation in the consumer. On the one hand, there's lots of savings on the sidelines, but the consumer, the lower end consumer, is under plenty of pressure, specifically the under 50K household income as inflation takes hold.
Oliver, this is what we want to talk about, and you've touched on it in a couple of ways there. Has the strength of the consumer changed, or is it just the basket that has changed, or is it both? What is it?
It's a little bit of both, John. I think the consumer pivoted faster than retailers could plan for. So retailers had to be very quick and agile. In the case of home product and big and bulky, that's a very long lead time category. So it was difficult to shift. And Target and Walmart had executed so well through the pandemic, really stocking up to offer great customer service, that this change was faster than expected. What's really next? We still see a very strong luxury consumer. We also think a consumer focused on value, such as Planet Fitness, Grocery Outlet. Those are great ideas. And then, Tom, as we think in themes, our second major theme is health, wellness, and beauty. As you know, we like Ulta a lot. And then thirdly, digital platforms like Revolve.
It was nice of you to mention, Tom, when you started talking about health and beauty there, Oliver, and not me.
Yeah.
Thank you, Oliver. Let's talk about Target a little bit more.
Yeah.
And I want to talk about whether we should write down the quarter or write down the year. We touched on this a little bit earlier this morning. The stock's down 7.8%, but that's about the pain in the quarter. And arguably an investor right now that's just spooked, lost confidence in any guidance this company provides. But they are still looking for a bounce back in margins in the second half of the year. Now, Oliver, I want you to help us understand how doable, how achievable that actually is. When they're looking for 2% this quarter, that's the damage, and they're looking to get back to 6% in the second half of the year.
Yeah, Target has assessed the situation. They're out with that press release today. And what will happen is these markdowns and markdown reserves will drive the top line. We've been in a volatile situation with the compares and what's been happening with the consumer. But this should be a good glimpse into what's achievable and doable, and a reset which was needed in terms of what they're seeing now. So looking forward, the fixture is on unemployment. Unemployment's still very low at 3.6%. That is something we're going to monitor, as a risk factor to retail at large. But now the consumer is going out again, and this portfolio and the markdown should be in the right place. Target has unique vulnerability because, keep in mind, grocery is about 20%. It's about 50% at Walmart, which has led to a little more stability in the Walmart numbers and guidance.
Oliver, how much does this challenge the model that came out of the pandemic, where a lot of companies, in particular retailers, were building up inventories to avoid getting caught up in supply chain disruptions?
Yeah, Lisa, what we liked about the pandemic in terms of retail is curbside pickup, these sortation centers, the integration of Omni. Those will be powerful tools for the long term, and also Target and Walmart running marketplaces. So there is a lot of positives that came out of building a better mousetrap for the long term.
Oliver, real quickly here, and we'd love to talk to you about luxury all the way on down to Target. We don't make light of it. It's really important. Could you explain to me why a sweatshirt at Target is $15 and a sweatshirt at Celine is $890? Explain that.
Well, Tom, the magic of retail, we teach it at Columbia, is magic and logic. Luxury goods really has a lot of emotional components that go into the good. And retail is about a willingness to pay model when it comes to apparel. What we also see happening is re-commerce and this move to sustainability. I'm here in Europe. It's a very big, important topic. So, Tom, I'd encourage you to look at resale. You'll get that Celine sweatshirt for 30 to 40% off.
Yeah, but what I know, John, which is so true, is they both shrink in the wash, which is my problem with Celine.
You are well aware of my
Well,
particular
you can try
predicament
Dior.
with that Celine
Dior might
sweatshirt.
work better.
No, Oliver, it's what happens when the other half wants to wear your sweatshirt and deliberately shrinks it.
Yes, this
in
happens.
the dryer. That's what happens.
That's what happens.
That's what happened. Oliver Chen, coward.
Thank you.
Oliver, thank you, sir.
Has the other half confessed to deliberately doing it?
We all know why she did it. We all know why she did it.
Has she
I haven't
defended
worn it
herself?
since. No, she laughed. She knows why it happened. So there we go. She's happy. Good for her.
Wow.
I'm trying to get it replaced. I'm trying to one day, because Tom keeps bringing this up every single month. I'm hoping that one day Celine just take a listen and replace the sweatshirt.
They should.
Is that what you're pitching here?
Let's talk about Target just briefly and get
Please.
away from this story. I think at the moment a lot of people are trying to take a macro signal from one retailer,
Yes,
or
yes,
maybe a
yes,
couple of retailers.
yes.
But when you speak to the retail analysts, it's so much more complex than
Yes.
just that. You ask them just direct questions, and we did it. Is this a change in the strength of the consumer, or just a change in the basket? And they'll often tell you it's a bit of both at the moment. It's a change in the basket, which is why I keep bringing up the airlines too, Tom. When you ask the airlines the health of the American consumer right now, it's pretty decent, right?
Right.
The price tolerance is sky
Above
high.
nominal, yeah.
Ask a retailer, different story.
Well, it is, but this is what we're trying to do, folks, is we don't want to go into general macro hyperbole. We want to go beneath the analyst headlines into what's actually going on at Target. To me, John, again, to be optimistic, Target's going to clear these challenges quickly.
I wonder how quickly today. Keep bringing this up, Lisa. If you were trading on the back half that things get better in the back half of the year, what happens to this stock? Who wants to buy this? I'm going to be looking for that going into the close.
How can you get confidence twice in 3 weeks?
Really hard.
Downward projections and forecasts.
Really, really hard. I'd be spooked.
This is incoming.
The whole market
message.
was 3 weeks ago, remember, when Target first came out with this.
I got a message in, John. Does the AC Milan jersey shrink in the dryer?
It doesn't cost as much as the Celine sweatshirt, let me tell you. This is Bloomberg. Live from New York City this morning. Good morning to you all on TV and radio. This is Bloomberg Surveillance. Your equity market lower, -0.8% on the Nasdaq 100. We are down by more than 1%. Yields coming in a couple of basis points. Call it 3.0122% on a 10-year. And the main event's got to be Target. If we can take a quick look at the name, the stock lower in early trading, lower by a lot as well. Off the lows, that's the good news. The bad news is we're still down by more than 7%, Tom.
Yeah, it is. It's going to be interesting to see. This is a lot of fun right now. We're going to do this here to keep the dialogue going. And I really want to focus on the CPI report that we're going to see on Friday. David Page joins, head of macro research at AXA Investment Managers. And what you don't see, folks, when we're on break is David Page and John Ferro come from some neck of the woods, and they were just reminiscing about the 3 or 4 day Jubilee as much as they could. And, you know, we're going to keep up this dialogue as well. Is inflation the same, David Page, in Middle England as it is in Middle America?
It's similar. I mean, we're getting much more pressure coming through from utility bills, so household costs, rather than from petrol or gasoline costs. So that's where the pinch comes differently. But energy is still energy. You're still getting that problem coming through. And services are starting to grow. You've got very tight labour markets for slightly different reasons, but tight labour markets in both. And that's feeding through to some of the services inflation as well.
Not the most mail I get, but pretty close. And as simple as I can, economists talk about core inflation we are living nominal top-line inflation. When are we going to stop doing that and start looking at 8% inflation?
Yeah, no, headline is what's key at the moment. And it's not only key because it's what's driving real disposable incomes, and it's the squeeze that we're feeling on the consumer, which is very similar in the UK, to a slightly lesser extent across Europe, but very similar in the US. So it's very important from that real disposable income point of view. But it's also inflation expectations, and that's what's got the central banks worried. So people, the man on the street doesn't look too much at core inflation. They're worried about headline inflation. They are worried about petrol prices or gasoline prices, and that's what's going to drive inflation expectations higher. At the moment, it's not happening. There isn't a big increase in medium-term inflation expectations. People are pretty comfortable with the institutions, albeit they know we're in for a brutal shock over the next couple of years. But that headline is the focus, I think.
David, how concerned are you about that study that came out yesterday? When you took a look at the 1980s inflationary wave and adjusted it to the spending habits of today, you got something very similar to what we're looking at now. The peak, as calculated by this study with Larry Summers that came out yesterday, at June 1980 was 9.1% versus the 6.2% CPI print that we've seen on the core level. Do you view that as a likely comparison that gives a sense of how much work the Fed has to do and whether we're going to head back to a Volcker era type of circumstance?
Yes. I mean, I think the Fed's first interim target is whether or not it can control the outlook for domestic inflation. I mean, very clearly the reason we're here is from a lot of external shocks, and that's the case for a lot of the economies. But you've got oil prices, which may well go higher over the summer. You've got the potential for a gas problem coming through in the fourth quarter, and you've got supply chain issues. Now, the Fed can do little about that and probably won't worry too much about that. It will assume over the next couple of years that those issues will fade back. What the Fed has to worry about is the fact that the domestically generated inflation is so high, and that's coming from a tight labour market. Now, from that perspective, what they need to do is slow the economy, and they need to gently raise unemployment. But we all know what a double-edged sword that is and how successful the Fed has been at making that very fine-tuned adjustment over the last several decades. So it's a huge challenge. And I think over the summer, particularly as markets try and second-guess exactly what the positions are going to be, it's going to be very difficult for the Fed to keep the markets exactly where they want them, tight enough to slow the economy, but not so tight as to tip them into a more outright recession.
And part of this is how quickly the Fed wants to get inflation back down to that 2% target. We've been talking about this for months, about whether they're going to be okay with 4% at the end of next year, or even 5%, or whether that will be a little bit too slow of a decline for their comfort. At what point do you see them thinking, okay, this is an appropriate pace, 4%, 3%, or does it have to get somewhere closer to 2% by the end of next year?
No, I don't think they can look for that. I think it's going to be you'd see a very sharp adjustment to get it coming back to that sort of level. So I think they've realistically got to be looking at getting inflation back on track by 2024. So they've got to be confident in their forecasts that inflation is going to be back to target in 2024. And that probably doesn't mean that you get anything like that in 2023. We're forecasting, roughly speaking, to see CPI just a little bit above 6% by the end of this year. And that's assuming we don't see too much of an energy shock at the end of the year. And then probably getting down towards just over 4% by the end of next year. So it is going to be quite a slow process when you look upwards. But, we're coming from 8.5%, possibly higher. So we are going to be looking at inflation falling back quite quickly. It's just that it's going to take a little while to get back to target.
Where's the value opportunity here? We've had a repricing of any given ratio you want to look at. Is the value opportunity the United Kingdom? Is the value opportunity America or continental Europe?
No, I think we might have to look even further afield than that. I mean, I think Europe is going to be a real risk over the next 6 months just because of the risk of the energy shock. We really don't know what's going to happen militarily in Ukraine, Russia. We don't know what's going to happen with the gas shock.
So where are you going?
So then we start thinking a little bit further beyond that, and we're looking, to see whether or not emerging markets can make some pickup.
So critically, do you need a weak dollar to own EM optimistically?
I think you need the dollar not to be moving up higher from here. And I think, the risks are that as we see those risks emerge, particularly if we see anything nasty happen in terms of China COVID again, things are looking okay for now. But as we've seen with Omicron on a number of occasions, it picks up again quite quickly. If we see risks in multiple parts of the world, that's what tends to see the dollar pick up even above and beyond, what we'd expect in terms of fundamentals.
What's your most contrarian call, David?
What's our most contrarian call? Well, I think we're at the moment, it sounds like our most contrarian call is that there's no preset path for recession in the US. We're hearing a lot about the early doors of the straws in the wind of a recessionary period coming through. But I don't think there's anything at this stage that commits us to an outright recession. It really does depend on whether or not the Fed how the Fed manages expectations over the next couple of meetings. So our view at the moment is that we avoid recession, but that probably means that the Fed stops much sooner than markets are thinking. We think that by the end of this year at 275, the Fed will have to stop. And that's not necessarily because the Fed is materially above a restrictive rate or anything else at that point. It's primarily because we think financial conditions are going to be tightening quite quickly over that final half.
Do you actually think that that's out of consensus? Do you think that currently a recession is being priced into U.S. equity markets, given the reaction that we saw to Target's revision further downward?
No, genuinely not. But listening to your show all morning, I think, there's a lot of talk about recession coming through.
Sure.
And I want to get it out there.
Talk. Look, honestly.
I almost spat out my water then.
that was a fair comment.
Lisa.
But what people say and what they do are two different things. Are you saying that there's sort of an overly bearish sort of tilt to some of the Wall Street analyses and perhaps some television shows, and that perhaps in reality, that's not what people are baking in the pricing of assets on the ground?
Yes, I think that at the moment there's no pricing for a recession, but I think everybody recognises that it's totally doable. I mean, I think it doesn't take too much, and I think when we see Fed Chair Powell speaking in a week or so's time, I think he is going to have to be a little bit more hawkish than markets are expecting, and that's going to tighten those conditions again. We've had a little bit of a relief rally, I think, in terms of what the Fed might do over the last 3 weeks, and I'm not convinced that that's going to be the message the Fed wants to leave us with.
On the break, I was getting all misty-eyed, folks, over Warwickshire, and, David Page and John Farrow doing it up. And so, John, I dive into Coventry Live, and they're not even talking about Coventry. They're talking about Cardiff and the Tots and where Gareth Bale is going to land.
Is that the lead story, Tom?
It is. That's the lead story in Coventry is Gareth off to Cardiff.
I think you're more interested in that than the people of Cardiff.
I know. I mean, Blanchflower away on this, I'm sure.
He's got his country into the World Cup, Tom. Fantastic.
It's great. I mean, the motherland is going to go to the World Cup, and that's fine. But, John, importantly here, does Bale go and be a national hero and drag Cardiff back to Premier League, go up a league, or does he go back to the Tots and come in for 5 minutes and save the day?
I really don't know. I mean, given the project that Antonio Conte is trying to build, I'm not sure where Gareth Bale fits into that.
Yeah.
That would be a one-year transfer.
David, thoughts?
What's amazing, David, is that he's only 32. He's 33 later this summer.
Yeah, I mean, his career is a mystery. I mean, at some point somebody should have said to him, go to a team where you are going to play because you're going to miss those years for so many, when you grow out of this.
John, that's what Lisa said to me in Davos. I overheard her in the restaurant.
Go
she
somewhere
said,
else.
Tom, his career is a mystery.
It's a mystery. You should go somewhere else. David Page of AXA Investment Managers. David, thank you. As I almost spat out my water, it just reminded me of something.
Thank God you didn't waste
I'm not going to name the
Tang.
guest. It would be so unfair for me to name the guest. I just remember the three of us were sat in a radio studio in February 2020, and a guest came in and looked at the three of us and said, "You're just so depressing this morning." It's just so depressing. Do you remember this?
Yes,
do you remember
I do remember this.
It's just so depressing. Things are going to be so much better than you think they are. And wow, they were so much worse, Lisa.
Hold on a second. But I also think that, honestly, sometimes, Tom, you'll say to me, "Oh, you sound so bearish." I'm not so bearish. Sometimes I'm just asking questions. I mean, sometimes I'm just trying to find out where the holes are in certain people's optimism, where the corners are.
When you ask about the balance of risks, they're predominantly about the downside risks and not the potential for upside risks. Is that fair?
Maybe.
Do you want to get some price action?
Please.
It's always available. Futures are down 0.9%. I needed some of that earlier. The Nasdaq down by 1.26%. We're pulling back once again as Target spooks investors just a little bit once again. If you experienced this 3 weeks ago, it feels familiar. It's because it's happening again in 3 weeks, twice. Target has had to cut the profit outlook and the stock is down and down hard in the pre-market. Off the lows, we were down about 10% of the lows. We're down by 7.4% now. That's a single name story. That's one stock, but it's one fear too, that this is more than just Target, Tom, that this is a bigger story. And we touched on this briefly moments ago.
Yeah.
It's tremendously difficult to get a macro signal from these guys right now because when you listen to the signal from the C-suite, when they talk about their company, they don't talk about the strength of the consumer. They talk about the changing basket of the consumer.
Yes.
That's different than just saying the consumer's weaker because inflation is higher.
And the problem I have with the media gloom on recession is, as one of our guests mentioned, maybe Vince Reinhardt, there's discussion of a growth recession which hammers certain deciles harder than others.
David Malpass is going to weigh in on this, the president of the World Bank, in the next hour
book Blanchflower
on Bloomberg TV. Danny will be on soon. He's very upset about these recession forecasts. He's basically saying it's guessonomics, and here we are. The weakness is here
correct.
Right now. It's not round the corner. Danny's got a lot to say. Doesn't think the Fed should be hiking either, Tom.
Yeah,
Shocker.
Well, we know that. He's dovish.
We do know that. Down 3 basis points on a 10-year, 3%, just about. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Boris Johnson is trying to draw a line under the controversy that's been threatening his leadership, but the scale of a mutiny against the British Prime Minister suggests his days may be numbered. Johnson survived a confidence vote by members of his own Conservative Party. Still, more than 40% of Tory MPs voted against him. Johnson now says it's time to get back to helping people with the cost of living. Hong Kong won't tighten coronavirus restrictions before the city's July 1st handover anniversary. That's according to Chief Executive Carrie Lam. There's been speculation that China's President Xi Jinping might attend the celebrations. Hong Kong's COVID cases have been rising since the city began rolling back social distancing curbs. And tourists visiting Japan may be sent home if they don't follow rules on wearing masks and sanitizing their hands. They also must buy private health insurance. Japan is set to allow package tours starting this Friday. Borders have mostly been closed to tourists since early 2020. Citigroup will hire about 3,000 employees for its institutional business in Asia. The new staff will work in areas including investment, corporate and commercial banking. The bulk of them will work in Hong Kong and Singapore. There will also be new jobs in India, South Korea, China and Australia. Apple has unveiled the most significant overhaul to its popular Macbook Air Laptop in more than a decade. It features a fresh design, new colors, and a speedier processor from its homegrown line of chips. Apple showcased the MacBook Air at its annual Developers Conference. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think the White House's message is pretty good. They are clear that inflation is high and that it's hurting. They are clear that the primary responsibility for bringing inflation down is the Fed, and they're clear that it's not going to be coming down instantly. I appreciate and admire that Secretary Yellen said that she made a mistake. I think we should have more confidence in her for her willingness to admit error.
Jason Furman, who visited us in Davos, and that is a tour de force interview. And if you would like more of this in the Wall Street Journal today, Jason Furman does what he is famous for, which is lining up the ducks with immense precision, confidence, and intellect as he compares inflation in the United States with the things in Europe that are going on as well. Really can't say enough about it. Part of that is the indicator of what the tea leaves are doing, including weak yen. Kriti Gupta on yen.
On yen against the Australian dollar, or I should say the Aussie dollar against the Japanese yen, which, Tom, is my favorite risk gauge when you look at what the implications are, what direction it's pointing to for things like the stock market, like high yield spreads, for example. The Australian dollar having that strong correlation with commodities and commodity exports, of course, the Japanese yen being that strategic haven for decades and decades. And that brings me to my chart of the day. We are looking at that currency pair going back to 2020. And really, you see this trajectory that looks a lot like the stock market until you come to November 2021, which was really that peak that you saw in the stock market before you had this big bear market that followed. And look at what the Australian dollar versus Japanese yen is doing. To our radio audience, it's going up, 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 while the stock market went down, 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 except in the last couple of weeks where you have seen this reversal. The question, though, is this reversal that you're now seeing in the stock market and the currency market, how much of that is coming from the signals of the RBA and the BOJ? Of course, we know the RBA also hiking rates unexpectedly by more of a margin overnight, Tom.
Kriti Gupta, thank you so much. Barry Ritholtz is far too young to remember the miracle of C.J. Lawrence research and one Edward S. Hyman. It was absolutely original, the granularity of Ed Hyman in parsing out inflation. And instead of the Friday inflation report, which is above the headline, maybe with a little treatment on apparel and other things, Barry Ritholtz has been looking at the microdata of inflation. Barry, what do you see?
So, it's interesting that everybody is so focused on what the Fed is doing to fight inflation, but the vast majority of what we see is still the hangover effect of the shift from a primarily services-based economy to a more heavily goods-based economy during the pandemic. We're still untangling the mess that created, and that has nothing to do with where the Fed is putting rates. That's going to work its way. The pig is working its way through the python, and it's going to take a while before that finishes resolving. I like to say transitory is taking longer than expected.
Okay, it's longer than expected, but the answer is we've got a core inflation of 6%. What is the makeup of that core inflation?
So a lot of that is obviously food and energy, which was already elevated before the invasion of Ukraine, which sent those prices even higher. We're going to be dealing with this for as long, elevated prices, at least in part for as long as that war continues. But, when you look at how the economy shifted during the lockdown, and then so you had a surge in demand for goods during 18 months, and then we reopen, and now there's a surge in demand for services. So when you look at airline tickets or vacation, try to get a hotel room in New York City, we went from one extreme, which was a 20% increase in demand for goods, which really tied up all of our supply chains and made a lot of pre-existing issues much worse. Now we're seeing the reverse of that. And since there's only so many seats on each airplane, the response is we're going to raise rates. And that was before price of energy went up. And now you're seeing an energy surcharge on top of it. So the same situation we were dealing with goods during the lockdown, we're now seeing in services as we're reopening.
Barry, why have markets gotten this so wrong, as we can see by the share price reaction to Target, frankly, to Walmart, to Amazon, adjusting to the shift?
That it's always challenging to get the timing right. I mean, who didn't expect to see companies ranging from Netflix and Amazon to Peloton, Walmart, Target, et cetera, and we could throw in, when will Home Depot and Lowe's suffer the same effect? It's easy to look at it in hindsight and say, well, of course we should have seen the demand fall would affect these companies once we began to reopen. Once we began to reopen, the reality is a lot of these companies began to fall in anticipation of that. I can't tell you when Home Depot and Lowe's are going to peak, but I would guess it's going to be before we see the top in real estate. Markets tend to anticipate this by a long while. It's the timing that's so challenging. So I think the market sniffed this out in advance in a lot of companies. It just didn't get it perfectly.
Barry, perhaps we're not going to head into a recession, and we're not in a recession now, as everyone agrees. Almost everyone, I should say. Almost everyone. There are some outliers. Are we going to see an earnings recession, though, given the inability for some companies to get ahead of the shift in buying preferences?
Yeah, heading into the pandemic, the entire 2010s was a fantastic period for earnings growth. And while a lot of people blame or credit low rates by the Fed for causing this spike in revenues and profits, you have to give a lot of companies credit for really hitting their stride post-financial crisis. Yeah, low rates are a factor, but it's only one of many factors. And then to see how everybody pivoted during the pandemic, a lot of companies did a lot of things right when we were in an uptrend. Now it becomes a whole lot more challenging.
Barry, thanks so much. Barry Ritholtz for the update today. Masters in Business, just a terrific column as well for Bloomberg Opinion. Lisa, VIX out of stick, S&P futures -40. Lisa, I just looked at yen, which has, of course, been my focus today. The yen weakness, going back to the depths of the 2008 crisis, is a depreciation of 40%. It has just broken through to new lows not seen, new weakness not seen since 2015. This is a backstory which is going to be front and center in months.
How much can they continue to diverge from the rest of a world that is moving to a decidedly positive nominal rate structure? They are still deeply negative in both real and nominal levels, and they are committed to it for the time being because inflation isn't picking up the way that it is. I want to point to this, talking of dollar strength. The trade balance. This is interesting. We actually saw an unprecedented reduction in the trade deficit in the United States in April, in that data that came out at 8:30. The reason being imports from China were down dramatically because of the closures, because of some of the restrictions on the ground. This just shows how quickly moving this economy really is.
And if China opens, how does that adjust the trade deficit?
Exactly.
I mean, the 87 billion statistic now is still highly unusual off of the shock of what we saw the last go-around.
Deeply negative. And so how much does that continue to persist and deepen once it opens?
It's required, folks, that we end Bloomberg surveillance with the phrase deeply negative, because we are a deeply negative show. Thank you, Professor Blanchflower, for watching. We'll be all Cardiff with Blanchflower here in a bit as well. Stay with us through the day. It is the most interesting and, of course, a focus on Target, on radio, on TV. This is Bloomberg.